Hello and welcome to the next session on capital market and securities law. So we are discussing lesson number 1, that is basics of capital market. We had divided this entire chapter into 3 parts. First one being the financial market classification, second one being the participants of the financial market, and third one capital market instruments. In the previous sessions we have completed the first 2 aspects or first 2 parts of the chapter. So in this session let's directly move to the third part of lesson number 1, which deals with capital market instruments. In the previous session I've clearly given a detailed explanation of what are instruments. So now let's directly dive in to the what are the various categories of instruments that are covered in our syllabus. There is a long list that has been provided. So one by one we are going to discuss each one of them. Let's directly begin by discussing the first category of instrument being equity shares. So now what are equity shares? Before going into the actual knowledge or discussing the category equity shares, let us have a brief discussion on what is a share. What is a share? What is a share? Share is a part of the share capital of the company. It is a part of the share capital of the company. So what is capital? Capital is nothing but the funds that are brought into the organization for setting it up, for expansion, for various other purposes. So capital is the fund that has been collected for setting up and running that company. Right? So a part of this share capital is called as a share. So the capital is going to be divided into various units and the single unit is going to be called as a share. So various shares put together is going to constitute the entire share capital. For example, if we say that the share capital of the company is rupees 10 lakhs and the company has decided to keep the face value of one share at rupees 10 each, then we are going to have the number of shares being equal to 1 lakh. So 1 lakh shares put together is going to constitute the entire share capital of the company. So share is one of the elements which constitutes the entire share capital. Various collective shares put together is going to constitute the share capital, right? So there are 2 categories of shares that are prevalent. One is the preference share. Other category is equity shares. So the share capital can have a combination of equity shares and preference shares. It can also have only equity shares, but no company can only have preference share as its capital. So we are going to see why and what are the reasons. So equity shares are also known as ordinary shares or common shares. Equity shares are also known as ordinary shares or common shares. Firstly, because these are the most common kind of instruments that are going to be issued by the company for the purpose of raising capital. Secondly, this is the most common form of instrument that is being traded in the market in the practical scenario. Thirdly, whenever a company is going to set up or incorporate itself, it is going to do the incorporation by creating something called as the equity share capital, because the equity shares do not have any redemption date, it does not have any maturity date, it does not have any payback period. You are raising the capital for long-term requirements of the company. The equity share capital of the company is permanent till the company is going to be in existence. Till then the equity share capital of the company is going to continue. Only when the company is going to wind up, at that point in time we are going to pay back the equity shareholders and bring the balance to zero. Till then, till the company is in existence, the equity share capital is going to be in existence, and that is why we say that they are the ordinary shares or common shares of the company, and these shares are issued by the company for the purpose of raising capital with the intention of having long-term financing needs. like I told you, once you have the equity share capital of the company, that is for a long duration, like any other category of instruments, whether that is a bond, whether that is a debenture or preference shares, they do not have any date of maturity. They do not have any end date to itself. It is permanent. Once you have created equity shares, those shares are permanent in nature until and unless the company does not wind up, the company does not strike off itself, or the company is not doing a buyback, or the company is not giving an exit opportunity. Till then the shares are going to go on. Till the existence of the company, the shares are also going to be in existence, and that is why we say that the company use equity shares to raise capital to satisfy the long-term financing requirements of the organization. Next, they represent form of fractional ownership of the shareholders in the company. What do we mean by that? We mean to say that a share reflects as a part of the capital. This we already know the definition. Share is a part of the share capital. But what does it represent? For example, let's take the same example. If this is the entire share capital, the share capital is 10 lakh rupees. The value per unit is rupees 10. We are going to have the number of shares to 1 lakh. We have 1 lakh shares. Now in this, if there is a shareholder and he is holding 100 shares of this particular company, we are going to call him as the shareholder of the company. We are going to call him as the shareholder of the company. The shareholder is also addressed to as the member of the company. He is also addressed to as the owner of the company, because that shareholders reflect the ownership of the company. So here shareholder is the owner of the company, but is he having the entire control over the company? Is he having the entire decision making in his hand? The answer is no, because he does not own the entire 100% of the shares of the company, but he is owning only a part of a bigger capital. Here he is only holding 100 shares in relation to 1 lakh shares that the company has issued. So he is only holding a percentage of the shares of the company, and this percentage reflects the fractional ownership. He is not the 100% owner of the company, but he is a part owner of the company with other existing shareholders of the company. So one share reflects a part of the share capital, and any shareholder who is holding few shares of the company is going to represent what is his ownership in the company on the basis of the percentage. What is the percentage? How many shares does he have, and how many shares does the company have? These two factors are going to determine what is the percentage of holding of a particular shareholder. So shares represent fractional ownership of the equity shareholder in a company, and these shares are also called as ordinary shares and common shares, because whenever in general parlance we say that I have made an investment of, let's say 10,000 rupees in company XYZ. So whenever I say that, that automatically means that I'm talking in a reference to equity shares. When I specifically say that I have made an investment of 20,000 rupees in the preference share capital of company ABC, I have to specify that I'm making an investment in preference share. Until and unless the word preference is not used, that automatically means that we are referring to the equity share capital, because that's the ordinary share capital. Whenever you only use the word share, that automatically means that we are talking about the equity shares of an organization. So what is a share? Share is a part of the share capital of the company. It reflects a part or fractional ownership of the shareholders within an organization. These are also called as ordinary shares and equity the ordinary shares and common shares. Plus, these category of shares are issued by the company to satisfy the long-term financing requirements of the organization, because equity share capital is permanent as long as the company is in existence. Now let's quickly look into the definition of equity share. The definition for equity share has been provided under Companies Act 2013. The explanation to section 43 gives the definition. It says that equity share capital means all share capital which is not a preference share capital. So they have directly not given any meaning for what is equity share capital. They've just said that if a share is not a preference share, then that means that category of share is an equity share. Like I told you, there are two categories of shares: equity shares and preference shares. If a category of share is not considered as preference share, then automatically it means that it is an equity share. What is the definition? They say that all the capital of the company is equity share if it is not a preference share capital. So if it is a equity share, then it automatically means that it is not a preference share. So actually they have not given any meaning for equity share. They have just connected to another concept, that is the preference share. If a share does not categorize itself as a preference share, that automatically means that it is an equity share. Now, what are the various characteristics of equity shares? Okay, so first one is the voting rights. Now, what is voting rights? What is the right to vote? All of us as the nationals of the country have right to vote for selecting who should be representing us, the citizens, in the government, right? We have a right to vote as soon as we attain the age of 18. Everybody has a right to vote, right to cast their vote at the elections conducted by the Election Commission of India. Similarly, in the company, we have two important elements. A company is going to be segregated into two important aspects. One is called as the management, another one is called as the ownership. The management is going to be taken care by the board of directors, and the ownership is in the hands of the shareholders of the company, whom we are also going to address to as the members of the company, right? These shareholders are not going to, in the day-to-day activities of the company, interfere in any way. Their role is only going to be to contribute capital to the company. That is the role of the shareholders. They have given money to the company for its running, for its day-to-day activities. But the day-to-day decisions of what are the projects to be taken, how to apply, how do we grow the business, how do we increase our income, what are the different strategies that we have to use, the entire management and running of the organization of the company is in the hands of the board of directors. But ultimately, the company's functioning is based on the money that the shareholders are going to give. So the shareholder should have some say in what the company is going to do. If we just give the money and keep quiet, the board of directors might do anything which might lead to the losses for the shareholders. Shareholders might want their money to be spent in a certain way. So in that case, they say that whenever the board of directors want to take some important decision, whenever the board of directors want to add some new member to the board of director, when they want to take any important merger amalgamation decisions, they have to also take the permission from the equity shareholders or the shareholders of the company. The board of directors, whenever they are going to make an important decision which is going to impact the shareholders, they have to take the permission from them for approving that particular transaction, for approving that particular decision. And how will the shareholders actually give the permission? They are going to give the permission by casting their vote. They are going to do that by casting their vote. Now, what is going to happen? The board of directors want to do something. They want to undertake some activity. Let's assume that they are talking about merger and amalgamation with some particular company. They want to do that activity. For that, they need the permission from the shareholders, because it is their money that is being involved in this company. So their permission is going to be required. So the board of directors are going to propose a resolution, and this resolution is going to be placed before the shareholders. And they have to decide whether we approve this particular proposal of the company whether we are going ahead with the proposal of the company or we want to reject the proposal of the company, and for that they have a right to vote. Either they can vote in favor of the resolution, that is the proposal that is being put forth by the board of directors, or they can vote against the resolution that has been posed by the board of directors. Right? And to do this, they are going to cast their vote, and this is the first characteristic of equity share, that the equity shareholders have a right to vote at the resolutions which are placed before them in the meetings. Now, this is clear. So let's look at the next aspect. What are the various categories of meetings that are going to be held? So in any company form of organization, like I told you, there are two important aspects. One is board of directors and one is the shareholders. The board of directors are going to call for board meeting to discuss the internal matters and various other aspects, and the shareholders will be called for attending the meeting in two scenarios. One is the annual general meeting, which they have to conduct every year once. It is mandatory to conduct this meeting. And one more is the extraordinary general meeting. Extraordinary general meeting. If you cannot wait for the annual general meeting for discussing certain aspects and for urgent or emergency requirements, you need to call a meeting of the shareholders to discuss important aspects. During the year, if you want to call for any meeting, that is going to be called as the extraordinary general meeting. And the shareholders have a right to vote at the general meetings. They have a right to vote at any resolution that is going to be placed before annual general meeting or extraordinary general meeting. They do not have any right to vote at the resolution that is placed before the board meeting, because the shareholders are nowhere in relation to the board of directors. They are not a member of the board for them to be even eligible to attend the meeting. It is exclusively only for the board of directors. So the shareholders have a right to vote, but they have a right to vote only on those resolutions which are going to be placed before the members meeting, before the general meeting, whether that is the general meeting, whether that is the extraordinary general meeting or whether it is annual general meeting, does not matter. If it is a members meeting or a general meeting, they have a right to cast vote on all the resolution, all the matters that are going to be put forth before these general meetings. So what do we identify? We identify that equity shareholders have a right to vote either to approve a resolution or reject a resolution, that is nothing but the proposal of board of directors, and to decide whether a resolution should be passed or not, they have a right to vote. And that is what we are talking about as the first characteristic of equity share, that they have voting rights. And what is it? We are talking that they have a right to vote at all the general meetings on all the resolutions. They have a right to cast vote on all the resolutions which are placed in the general meeting, whether it is extraordinary general meeting or annual general meeting. Whichever resolution is going to be placed in the general meetings, they have a right to vote, but they do not have a right to vote in the board meeting resolutions. And these votes control the management of the company. Indirectly, what the board of directors are going to do is in the hands of the shareholders. They have to give approval for major decisions within an organization. So that is why we say that indirectly the entire control of the company is still in the hands of the owners, who are going to give approvals or reject the approvals or the board's proposals that are going to be put forth before the general meeting. Second important characteristics of equity share is that they have a right to share the profits of the company. They have a right to share the profits of the company. Now, what does that mean? That simply means that the company is going to be set up from the capital. This capital is going to be given to them by the shareholders, right? So, whatever money the shareholders are giving in the form of capital that is invested into the company, and when the company operates on the basis of this capital, they are able to generate income, and that income, when it is really doing well and performing well, will become the profits of the company after deducting all the expenses and other requirements. So when the actually company is earning profits, they are earning profit because somebody has given them money to run their organization. So we should think that even the shareholders should have some say in the profits of the company. They should have a right in the profits of the company. They should be able to claim those profits because it is from their money that the company is even running, is even operating itself. So yes, the shareholders have a right to participate in the profits of the company, and that can be done in two ways. It can be done in two ways, two methods. The first one is by dividend, and second one is by the way of bonus shares. What is dividend? Dividend is nothing but the profits of the company is going to be given to the shareholders in the form of cash. So if they have generated some amount of profit, this profit is going to be not going to be distributed to the shareholders in the form of cash. How much it has to be distributed, that is left to the decision of the board of directors. And next one is bonus shares, where we are not going to give you any kind of cash. We are not giving you cash, but we are going to give you shares of the company, additional shares of the company free of cost. Instead of giving you money for in the form of dividend, we are going to give you shares, extra shares of the company. So what is the scenario? Whenever there is a company and the company is going to make profits, the company has three options. What are the three options? First option is that it can retain the profits. Retain the profits. What do we mean by retain the profits? They can keep the 100% of the profits within the company for some other objective that they already have. So in this case, we are not sharing the profits. We are not sharing the profits with the shareholder, but still the shareholders can earn returns out of this decision of the company, because when the company has made profits, that profit is retained within the company. That means they are putting that money somewhere in productive use. They have an objective that we want this money for some utilization. By utilizing that particular money for that particular objective, they can work towards betterment, they can perform better, they can have more production, they can have more revenue, they can have more profits in the long duration. That will lead to capital appreciation, increase in the market price of their shares, which is also one form of return to the equity shareholders. So even though company does not distribute the profit or share its profit, still it can give returns to the equity shareholders in the form of capital appreciation. But this is not what we are going to address now. We are talking about the scenarios where the equity shareholders have a right to share the profits of the company. Second situation is where the company decides to do 100% payout. Whatever profits are there, they are going to share it with the shareholders. So whatever profit is there, they are going to pass on that to the shareholders in the form of cash, in the form of rupees. Actually, they are paying you money. And third category is when they are going to do part payment. Partly they are going to talk about retaining their money, and partly they are going to talk about the distribution of profit. Partly they are talking about retaining the money, and partly they are talking about distribution. Right? So these are the three options that the company has whenever they are going to have profits within the company. What are the two ways of giving profit? Okay. What are the two ways of giving profits? Let's discuss that applies in both the given scenarios. In both these cases, whenever company wants to make a payout, they have decided that this much money we have to give it to the shareholders for the purpose of sharing the profits. There are two ways. We already know one way is by the way of dividend, another way is by the way of issuing bonus shares. What happens here? Directly profit is there. The profit is going to be given in the way of cash itself to the shareholders. But what is happening in case of bonus shares? In the case of bonus share, whatever profit is there, that profit is going to be capitalized. Means we are going to move this capital to the share capital account of the company. We are going to add more shares to the company's share capital, and those extra added shares are going to be distributed to the already existing shareholders of the company. So these are the two ways in which the company can share its profit with its equity shareholders. So yes, the equity shareholders have a right to share profits. They have two ways in which they can share the profits. One is by the way of dividend, where they are going to get cash. Cash means they are going to do bank transfer, or they are going to give check. Earlier they used to send DD and checks, but now they are going to do electronic transfer. And next is bonus shares, where the profit is going to be transferred to share capital account by capitalization, and whatever extra number of shares have been added to the share capital, on the basis of that, to the existing shareholders on proportionate basis, we are going to give some extra shares. But the most important thing here is, do the equity shareholders have a right to demand for sharing the profits? Do they have the right to demand for declaration of dividend? Do they have the right to declaration of bonus shares? The answer is no. Why? The equity shareholders can share profits provided the board of directors are ready to give to them. Because ultimately, I told you, the company has multiple options. Either they can retain the profit, or they can give 100% payout, or they can do part retention and part distribution. That is their choice. It is the total discretion of the board of directors about what they want to do with the profits of the company. The equity shareholders can receive it if the board of directors are ready to give. The equity shareholders never can demand the company that give us dividend. You're making so much profit, share it with us, give us dividend, give us bonus shares. Such right we do not have. If the board of directors with their discretion are putting a proposal before you that we want to give you dividend, then we are going to take the dividend. Otherwise, we are not going to have any right to demand the sharing of profits. So we have no right to demand the declaration of dividend. We only have a right to participate. We only have a right to receive if the board of directors want to share those profits with us. And lastly, the third important characteristics of equity share is repayment of capital. Like I told you right at the beginning, that equity share capital is permanent in nature. Once the company has created equity share, it has created a equity share capital that is going to be in existence till the company goes on. That is going to close, or that equity capital is going to be returned back to the shareholders only when the company is going to go for winding up. And even at that point in time, first the company is required to clear all the creditors, all the money that is due by the company, whatever payments it has to make. After making all those payments, after that, if anything else is received left over, that money is going to be given to the equity shareholders. So what do we mean? They say that with respect to repayment of capital, at the time of winding up of the company, payment to the equity shareholders will be made only after the claims of all the creditors and preference shareholders are settled. First, we should clear all the dues that are there, all the creditors should be made the payment of, all the preference shareholders should be given their investment, and lastly, whatever amount is left, that is left for the equity shareholders. If it is less, they are going to get less. If it is more, they are also going to get more and above, over and above the capital that they have contributed. So that is it. These are the three important characteristics of equity shares. First one is they have a right to vote at all the general meetings and at all the resolution placed before the general meeting. Second one, they have a right to share the profits of the company only if the board of directors want to share in the two forms, dividend and bonus shares. Thirdly, when are they going to get back their capital? The repayment of capital is going to be done for the equity shareholders only at the time of winding up, and that too after all the other dues are cleared, after all the creditors are paid, after all the preference shareholders are paid. After that, whatever balance amount is there, that is going to be paid to the equity shareholders. So these are the three important characteristics of equity shareholders. Equity shares as such. What are the different categories of equity shares? So section 43 of the Companies Act 2013 says that the equity shares can be divided into two characteristics. One is equity shares with voting rights. One more is equity shares with differential right as to dividend and differential right as to voting or otherwise in accordance with such rules as may be prescribed. So they are saying that there are two categories of equity shares. One are the regular ordinary equity shares which have basic voting rights, and one more is equity shares with differential rights as to dividend or differential rights as to voting. Now let us look into more details of these aspects. So we know that we have equity shares. First category is equity shares with voting rights. Second one is equity shares with differential rights as to dividend, voting or otherwise. Okay. So when we talk about the regular equity shares, we know that equity shares carry voting right. Okay, when we say that they carry voting right, what does that mean? It means that at any resolution that is going to be placed before the members, they have a right to cast vote. But how many votes will one person be entitled to cast? Because every shareholder is a fractional owner. Somebody is having 10% ownership, somebody is going to have 50% ownership, somebody is going to have 0.5 ownership, somebody is going to have 0.7 ownership, somebody is going to have 2% ownership. Every shareholder is going to have different ownership depending upon how many number of shares they are holding in the company share capital. Depending upon this, we are going to determine what is the ownership level. Now, should we give somebody is holding 10% shares the same voting power that we are going to give a 50% shareholder? Is it possible that on the basis of, can we say that one shareholder has one vote? Will that be fair on the part of the people who have contributed more money to the share capital? I have given 10 rupees. Somebody has given 1 lakh rupees. Should he have more control over the company, or should I have equal control as that person has? Definitely, to avoid these kind of conflicts, we have said that we are not going to determine the voting power on the basis of shareholder. We are going to classify we are going to give the power in the hands of the owners on the basis of how many shares they are holding. So if you have 1 share, you are going to have 1 vote. If you are going to have 10 shares, you are going to have 10 votes. So that will remove any kind of bias or any kind of conflict that might arise because somebody has contributed lesser amount, somebody has contributed more amount, but both are treated equally. So to avoid any kind of these conflicts, we have come to a general principle that if you have 1 share, you have 1 vote. How many shares you hold, those many votes you have a right to cast at the general meeting. So when we say that equity shares or regular equity shares with voting rights, these are the shares which carry 1:1 ratio. For every 1 share, you are going to have 1 vote, because vote signifies power. Because ultimately what is happening within the organization, we have to pass or make certain decisions. To reach those decisions, we have to cast a vote. Either we have to approve a particular resolution or reject a resolution. And this approval or rejection of a resolution is based on how many votes it has received when it has been put before the members. And these vote itself determine whether a particular resolution is passed or it is not passed. So ultimately, people who have more votes in their hands will have a control over the decision making, and that is why we say generally that the promoter group members do not want to give away a lot of control of the company by diluting the shares. They do not want to give a lot of percentage of holding within the organization to a stranger or to a third party, even to the public at large. So that is why we say that the voting power is the major power within the organization, because how many votes you have is going to determine whether a particular resolution is going to be passed or not. It is going to have a say, higher authority, higher power in the decision making process. That is why we say that general ordinary equity shares is with the general rule that if you have one share, you have one vote. How many shares? Those many votes. What are the second category of equity shares? Second category of equity shares are the shares which have differential rights. Differential right as to dividend or differential right as to voting. What does that mean? It means that we are going to create a segregation, we are going to create a division, and in that also there are two forms. One is equity shares with superior voting rights, other one is equity share with inferior voting rights. What does that mean? It simply means that the ordinary shares, the ordinary equity shares are going to have 1:1 ratio. For every one share, you are going to have one vote. This is the general rule. Okay, this is the general rule that is applicable. But on the other hand, if the company is going to give out or make a differential voting rights shares, in that case, again you have two categories. One is superior, one is inferior. What is superior? Superior means somebody has more power. When we want more power, what does that mean? For more power, you should have more voting rights. You should have more votes in your hand. So what are equity shares with differential voting rights with superior characteristics? For every one share, you can have 2 votes. You can have 5 votes. You can have 8 votes. You can have 10 votes. This is the choice of the company. At the time of issuing the terms and condition itself, they can say that we are issuing equity share where one share is going to carry 5 votes, one share is going to carry 10 votes. So the maximum permissible limit is 1:10. For every 1 vote, you can have up to 10. For every 1 share, you can have up to 10 voting rights. Right? You cannot cross over and above 10. It can be anywhere between 2 to 10. Okay? For 1 share, 2 votes, 1 share, 3 votes, like that, up to 10 votes you can have. That is the maximum permissible limit as per the provisions of SEBI laws as well as the provisions of Companies Act. So what are superior voting rights shares? Share where for 1 share you have more voting rights. For 1 share you carry more voting power, right? Next, what are the inferior shares? Exactly opposite to what is that of the superior. You have lesser voting rights. You have less power. That means for 10 shares, you are going to have 1 vote. Or for 8 shares, you are going to have 1 vote. For 5 shares, you are going to have 1 vote. So you have more shares, but the voting power with respect to those shares is less, right? Now, this is the basic. What are the 3 categories of equity shares? Equity shares with regular general principle, 1 vote, 1 share. Then you have equity share with differential voting rights. They are then further segregated into superior right shares and inferior right shares. Superior right shares are those shares where the shares are going to carry more voting power, whereas inferior shares are the shares where we are going to carry lesser voting power, more shares but less votes. This is the basic. Now my next question is, can a company list its equity shares with superior voting rights on the stock exchange? Can the company issue these equity shares with superior voting rights to the public at large? What is the answer? The answer is no. Even if it is permitted, none of the promoter group members would want to make an issue of superior voting rights shares to the general public, because that means you're handing over the power or control of the company to the general public at large. You are giving them more voting rights. You're giving them more power, but that is not what we want. We want to retain, we as promoter group members want to retain the control over the company. We want to have major decision making in our hand, and we can do that only when we have the major voting power in our hand. If we give away the voting power, we are going to lose the control within the organization. So the general principle is no company is permitted to list its equity share with superior voting rights on the stock exchange. But on the other hand, the companies are permitted to make a issue of equity shares with inferior voting rights to the public at large. Why is that? That is because the companies want capital to run, but they do not want to give away the control. So here you are taking money from them. You're taking money from them worth 10 shares. But you're giving them only one vote to cast, because even the shareholders might be of the point of view that we do not want control. Ultimately, we are not getting into the basics of it is somebody else's company. We only want our money to grow. We don't want it to get into the decision making also. Neither do we want control over the company. What we want is only growth for our money. And we know this company is performing well. Even if the voting power is less, it's okay. I'm going to put my money because anyways the money is going to grow. I don't want the management. I don't want to get into the ownership of the aspects. I don't want to even look at attaining control over the company. So for those category of investors, for those category of shareholders who are not looking at gaining control over the organization, they are okay with having 10 shares and having only one voting power. So this is beneficial for the company because they can raise more capital but still give away very, very little control in the hands of the equity shareholders at the time of making a decision, at the time of giving approvals or rejection for the resolutions that are going to be put before them. So what is it? They have different categories of equity shares. Equity shares can be classified into two: regular equity shares, 1:1 ratio, 1 share, 1 vote, or equity shares with differential rights. Equity shares with differential rights are further classified into two: superior shares, inferior shares. Superior shares are the shares where we have more voting power. For less number of shares, we have more votes. On the other hand, inferior shares, we have more number of shares but lesser voting power is given to those shareholders. Equity shares with superior shares cannot be listed on the stock exchange. Neither the promoter group members want to make an issue of those category of shares. It is always going to be retained within the organization. And second category is inferior shares, which is beneficial for the company because they can raise more amount of capital by giving out very less control in the organization by giving them less voting power. So this is the basics of different categories of equity shares. Again, when we talk about equity shares with differential rights, there are two classifications. One is on the basis of dividend and on the basis of voting. On the basis of voting, how I have given a classification. Similarly, on the basis of dividend also, they can have terms and conditions saying that for so many number of shares, dividend is going to be issued. Generally, 1 share, the dividend. Whenever they declare dividend, they say for every 1 share, we have issued a dividend of 2 rupees. That is the general way. For every 1 share, 2 rupees dividend is going to be given. But when you have equity shares with differential right as to dividend, they can say for 5 shares, this is the dividend. So on that basis, terms and conditions, the company can make any kind of issue. So this is the category of equity shares. Next. Shares with differential voting rights. Let's see the theoretical part. These refer to equity shares holding differential right as to either dividend or differential right as to voting. Section 43A(2) of the Companies Act 2013 allows the company limited by shares to issue differential voting rights as a part of its share capital. Yes, the Companies Act permits the issue of differential voting rights shares, whether it is superior or inferior. Both are permitted as per the Companies Act of 2013, because again, Companies Act is applicable both to private companies and listed companies. So they are going to permit it. But the listing on stock exchange is permitted only with respect to the differential voting rights carrying inferior rights. But yes, public limited companies can also issue equity shares with superior rights, but that is not issued to the public at large. It is only retained among a few selected people. Since issuing of these shares provides an option for raising investment and retaining control over the company at the same time, it is important to regulate the issue of such shares. That is what here specifically they are talking in relation to the inferior shares, where the company can actually raise a lot of money by raising capital but giving away a very little control by giving less voting rights or less voting power. Now, shares with differential voting rights. can be issued by the company subjected to the conditions that they satisfy these important conditions that have been provided for. So yes, we have conditions to issue equity shares with differential voting rights. Section 43 subsection 2 of the Companies Act, read with the relevant rules, provide for these conditions. The first and foremost is authorization in the Articles of Association. What does that mean? Companies Act 2013 gives the permission for the companies to issue equity shares with differential voting rights. But if that is not permitted in the Articles of Association, the company cannot go ahead and make an issue. It should be included as a clause in the Articles of Association that yes, the Board of Directors are permitted to make an issue of these category of shares. So if your Articles of Association does not include a clause where you can make an issue of such differential rights shares, first you have to make an alteration to your Articles of Association, amend your Articles of Association. After making the changes, then give a proposal of making an issue of these category of shares. So the first permission that you need is from the Articles of Association for making an issue of these category of shares. Second one is that the voting power of shares with differential voting right shall not exceed 74% of the entire voting power. What do they mean? They mean that 100% of the shares of the company cannot be shares with differential voting rights. It is not possible. You should have some basic ordinary shares which are going to carry 1:1 ratio. All your shares cannot be the shares carrying differential voting rights. The maximum that you can allow is 74% of the entire voting power. The entire 100% voting power of the company can be 1:1 ratio. But in case you want to issue differential voting rights shares, then maximum it can be 74%. The remaining whatever percentage is there, that has to be the 1:1 shares. This can be differential voting rights. So the total voting power is going to be considered, and out of that, the maximum that voting power can be given for these category of shares is 74%. So that the remaining part should be your basic ordinary equity shares carrying 1:1 ratio. Next, third one is approval from the shareholders by passing a ordinary resolution. So you've got the permission from Articles of Association. They've told you how many number of shares you can issue with respect to shares carrying differential voting rights. And now we have come to the third aspect where you have to take the permission from the existing shareholders. Existing shareholders might have 1:1 ratio. Now if you are telling that we are going to give more shares, more voting power to a certain selected group of people, they should give an approval for it. They are going to place a resolution before the general meeting, whether it is AGM or EGM. They are going to give a proposal that we want to issue shares with differential voting rights. Will you give an approval or not? You have to vote at the meeting to approve it or not. Only if you get the approval. How much approval is required? We are required to pass an ordinary resolution. Ordinary resolution means simple majority. That means if 100 people are casting vote, even if 51 votes are in favor of the resolution for issuing these category of shares, the company can go ahead and make an issue, right? So again, there are two categories of a resolution, and every different resolution requires a different results, okay? You have two categories. We have ordinary resolution and we have special resolution. Ordinary resolution means simple majority. Simple majority means 50% of or more votes in favor of the resolution to pass it. Special resolution is where you need a special majority. What is a special majority? You need 3/4 of the votes, that is 75% or more votes should be in favor of the resolution to consider it as passed or approved. So here in this case, we are looking only for ordinary resolution. That means if out of the people who are casting vote, 50% or more of them cast in favor of the resolution approving the issue of differential voting rights share, only then the company can go ahead and make an issue of these category of shares. So what are the conditions? First one is you need permission from the articles. Second one is we have maximum number of shares limit. Not more than 74% of the total voting power can be as differential voting rights power. And thirdly, you need the permission from the existing shareholders of the company by passing a simple resolution. Ordinary resolution is sufficient, where simple majority is going to be required. And lastly, the company should not have defaulted with respect to 5 important things. If the company has defaulted in any one of these ways, the company will not be permitted to make an issue of differential voting rights share. So what are those things that there should be no violation? There should be no violation with respect to no default by the company for filing annual returns and financials for the previous 3 years. What does that mean? Like every company is going to require to be file income tax. Every individual is required to submit an income tax. Similarly, every company is required to submit its annual return to the Registrar of Companies, Ministry of Corporate Affairs. We are required to file MGT 7, AOC 4, or in case it is a small company, MGT 7A, AOC 4. All these forms are required to be submitted to the Registrar of Companies. If any company fails to submit their annual returns and financial statements to the ROC for the previous 3 years, in any of the previous 3 years, they will not be permitted to make an issue of differential voting rights there. So there should be no default in filing the annual statements and the financial statements and annual returns. Second one, there should be no default in the repayment of deposits and declared dividend. What does that mean? What are deposits? You have taken deposits. There is a maturity period. At a point in time, you have to pay back the money to the deposit holders. The maturity has happened, but you have still not given the money to the deposit holders. In that case, there is a default from your side. You should make the payment at the time of maturity. Even if there is a little delay, we say that the repayment has not been done. So if there is any default in repaying the deposit holders, then the company is not permitted to make an issue of differential voting rights share. Second aspect is, if the company has declared a dividend, we know within 30 days they have to make a payment of dividend, but if the company has failed to pay the dividend even after the declaration and the period of 30 days that has been provided, then we say that the company has defaulted in making the payment of dividend. And if there is this default also, the company is not permitted to make an issue of equity shares with differential voting rights. Third kind of default is redemption of preference shares and debentures. So even the preference shares and debentures are going to have maturity period. They are going to have redemption date. On that date, you are required to pay back the debenture holders. You are required to pay back the preference shareholders. Whatever capital they have contributed, you have to give back that money to them on the maturity, on redemption. And if you fail to pay the money to the preference shareholders and debenture holders at the time of maturity, at the time of redemption, we say there is a default. And if there is this default, you will not be permitted to make an issue of equity shares with differential voting rights. Fourth one is, if the company has defaulted in the repayment of any loan, then also it is not permitted. So repayment of any loan that have become due and payable. And lastly, if there is any statutory due to the employee, if any money is due, any salaries are due, any PFs are due, any gratuities are due, any money that is due from the company to the employee, if those dues are pending, then the company is not permitted to make an issue of equity shares with differential voting rights. So what is the gist? We are understanding equity shares. We saw the characteristics. We are seeing the classification of equity shares. Equity shares are classified into regular equity shares and equity shares carrying differential right as to voting and dividend. In that, if you want to issue differential voting rights share, you have to satisfy certain conditions. First one is permission from the Articles of Association. A clause should be there permitting the company to make such an issue. Second one is, you also need the permission from the existing shareholders by passing an ordinary resolution, that is a simple majority. Third one is the maximum permissible shares that can be issued, but that is not more than less than 74% of the entire voting power of the company can be in the form of equity shares with differential voting rights. And lastly, there should be no default by the company with respect to 5 things. First one is with respect to financial statements of annual returns for the 3 previous years. Second one is, there should be no default in the repayment. In the repayment of what? In the repayment of deposit to the deposit holders on maturity and declared dividend. If you have declared a dividend and not paid it, even even in that case, you are not permitted to do it. Third one is in case you have defaulted in the repayment or at the time of redemption of what? Redemption of preference shares and debentures. Fourth one is if you have made a default in repayment of your money or the loan that you have taken, any kind of loan credit you have taken. And lastly, if you have any kind of dues to your employees. In this case, if you have conducted any kind of default, you will not be permitted. So there should be no default by the company for these 5 aspects. If all these 4 conditions are satisfied, only then the company is permitted to make an issue of equity share with differential voting rights. Okay. So we have understood what are equity shares, we have understood the characteristics of equity shares, we have understood the classification of equity shares. Let's move to understanding what are the various rights that the equity shareholders are going to carry. So like I've already told you, we are studying capital market and securities laws from the point of view of listed companies. And for any listed company, Companies Act is applicable. In addition to that, SEBI laws are also going to become applicable, and that is why we are going to see the rights of equity shareholders from 2 perspectives. One is what are the rights of equity shareholders under the Companies Act 2013. In addition to that, they are also going to have some specific rights in relation to the SEBI LODR regulation 2015, that is listing obligations and disclosure requirement regulations. Under that also certain rights are there. Certain rights are overlapping, but there are certain specific rights or more rights are given to the public shareholders in listed companies. So we are going to draw that analysis. First one is right to vote, which we have already discussed in detail. You have a right to subscribe in case of further issue. What is further issue? You have made an initial public offer and the company has become listed entity. After that, the company is further raising next round of capital. In that also, the already existing shareholders have a right to make an application for getting extra shares. Similarly, this can happen even for private companies, where the company is going to call for extra capital. Existing shareholders itself can also bring in more capital. Right to appoint proxy and attend and vote. You have a right to appoint a proxy for the purpose of attending the meeting and voting on your behalf. What does that mean? Generally in colleges, if students bunk, they have their friends who can give a proxy for them. Because in colleges, there are huge classes, huge number of students. So the teachers are only going to call for attendance. You have to just say present if you're there. If you're not there, it is going to be absent. So even when some student is absent, some other friend is going to mark an attendance by proxy. That is what is going to happen even here, but it is going to be regulated. It is going to be as per the prescribed procedure. I am the shareholder of the company, and let's assume we are talking about me being a shareholder of a listed company. They are going to conduct the meeting at the headquarters. Let's say the headquarters is situated in Mumbai. I am somewhere in the southern part of the country. I am not even in the same city. I am not even in the same state, let alone the city. So I am not in a position to go to that particular place to physically attend the meeting and cast my vote because of various reasons. So if I am not able to go and attend the meeting, I can appoint somebody else for the purpose of representing me in the meeting on my behalf. But I cannot just do that on the last moment. There is a protocol. I have to send an acknowledgement to the company saying that I am so and so person, shareholder of the company. I am going to appoint this person. Name also should be specified that this person is going to be my proxy who is going to attend the meeting on my behalf. We have to communicate to the company, the existing shareholders who are going to appoint the proxy, they have to give a communication to the company that on my behalf so and so person is going to come and attend the meeting, right? So that is the right to appoint a proxy. If you cannot go, you can send somebody else as your representative to attend the meeting. Not only to attend the meeting, but also to cast a vote. That person is going to cast the vote in accordance to the direction that the existing shareholder or the original shareholder has given the proxy. Next, right to receive a copy of annual accounts. Now, it is from our money that the company is running. right? The entire company is in existence because of the capital that has been brought in. So as a shareholders, we have a right to know what the company is doing with respect to its finances. What are the financial statements? Okay, how you have spent the money, what are you doing, what are the projects you are involved in, where are you spending, right? All these details we have a right to know. How much profit is there, how much loss is there, what are you all doing, right? To get to know those details, we need the financial statements. So they say that every shareholder should be given a copy of the annual financial statements. You have a right to receive it from the company because you are the shareholder of the company. You have a right to know about the financial status of the organization. Earlier, the companies had to physically print out so many copies of their financial statements and post it to each and every shareholder of the company. Imagine the expenses. Now, over a time of technology, we have moved ahead, digitalization, we have accepted, we have created a rule also that the company can issue these financial statements to the shareholders by emails. You can send the email, you can send it to them via email, mail it to them, and in case a shareholder specifically says that no, I don't want to receive an email copy, I want a physical copy, you have to accept his request and give him the physical delivery of the financial statements. But the general rule is you can send it through the electronic mode. So yes, every shareholder has a right to receive the financial statements of the company. Right to receive notice of the general meeting. General meetings are meeting of shareholders, right? And you have a right to go and attend the meeting because you have a right to vote at those meetings. You should be present in the meeting to cast your vote. If you don't know only when the meeting is going to be conducted, what time, which place, what is the meeting agenda, what is the discussion that is going to take place, how will you even be present at that meeting? So you as a shareholder have a right to receive the notice of the meeting. At least we say clear 23 days notice, clear 21 days notice, that is 23 days. Clear 21 days notice should be given for calling any general meeting, right? So you should get a notice that on so and so date at so and so place at so and so time we are calling for the general meeting, please be present. If it is possible, the shareholder is going to come. If it is not possible, he is going to skip. If possible, he is going to appoint a proxy. But the intimation should be given that on so and so day, so and so place, so and so time, this meeting is going to be conducted for the shareholders and this is the agenda for the meeting. That communication is required to be made, and that is the right of the shareholder to receive such a communication. Then, right to inspect the statutory registers. Right of inspection. What are registers? You have various registers, attendance registers, right? You have, register of members in the company, you have register of debentures holder in the company, you have register of meetings in the company. N number of registers are required to be maintained by different categories of organization. If a particular register is mandatorily required to be maintained as per a statute, as per a provision of law, we call this as a statutory register. Like every company is required to maintain a register of members, register of beneficial owner, register of debenture holders, all register of charges. These are the mandatory statutory registers that the company is going to require to be maintaining. As a shareholders, we have a right to inspect those statutory registers. Next, right to requisitioning extraordinary general meeting. Now, generally what happens? It is the company who needs certain kind of approvals from the shareholders. So they call for the meeting of members. Yearly once they have to call, they are going to call annual general meeting. And in between the year, if something emergency is there, some urgent matters are required to be discussed or approvals are required, they are going to call for extraordinary general meeting. That is the responsibility of the board of directors to call for the general meeting and take the approval as and when required. That is the generally ordinary course. But what if the other way around? What if the equity shareholders want to discuss something with the board of directors? What if the equity shareholders want to propose some resolution to the board of directors? What if the board of directors have failed to call for a meeting at all? They are required to call for a meeting, but they are not calling the meeting. In that case, we say that the equity shareholders have a right to tell the board of directors, you please conduct a meeting for so and so reason. We want to propose something. You have failed to conduct a meeting, so we are going to request you please conduct this meeting for the equity shareholders. So yes, the equity shareholders also have a right to ask the board of directors to call for a general meeting. And in case After the request also, board of directors don't call for it. The shareholders among themselves can call for a meeting, conduct the meeting, and later whatever expenses are incurred, they can get the reimbursement from the company itself. So yes, they also have a right to call for a meeting. It is not only that the board of directors should call the general meeting, even the shareholders, but certain percentage is required as per the Companies Act. If those percentage of shareholders are wanting to call for a meeting, the board of directors have to constitute that meeting for the purpose of those shareholders. So these are certain rights that are provided for the equity shareholders under the Companies Act. Now let's move to the right of shareholders as per the LODR regulation. First one is right to participate in decisions concerning corporate changes. Basic, whenever there is a corporate reorganization, corporate restructuring, mergers, amalgamations, n number of aspects, at that time in the decision making process we are going to involve the shareholders. That is nothing but the right to vote on matters related to corporate changes. You have a right to participate and vote at general meetings at any resolution, not only in relation to corporate changes, but generally any resolution where the shareholders' approval is going to be required. In those resolutions, equity shareholders have a right to cast their vote. Right to be informed about the rules and the voting procedures as may be required, and this is very, very essential for listed companies, because in listed companies we are going to have shareholders from across the country, right? And by that virtue, now we are also permitting e-voting for certain resolutions for certain matters. When e-voting is facilitated, you are allowing the people to cast the vote from their respective places. You should tell them what are the rules. You should tell them how to log in, where to log in, how to cast the vote, what are the details. Those kind of information, receipt of that information is also very important. So yes, as equity shareholders, we have a right to receive the information about what is the voting procedure, what are the voting rules, how we should cast the vote, when we should cast the vote, when is the voting lines open, when it is going to close. All these basic details are required to be communicated to shareholders, and they have a right to receive these informations. Right to question the board of directors, that is there with any shareholder. Right to place items on the agenda of the general meeting. So whenever a meeting is going to call for, some agenda is going to be there. We meet because we want to discuss something. That is the agenda of the meeting. Generally in the agenda, the board of directors are going to create the agenda and send. At any point in time, if the equity shareholders want to discuss something, they can tell the board that this is the point that we also want to discuss. Please include it in the agenda. We want a discussion on so and so topic. That can be included at the request of the equity shareholders. Right to propose a resolution. It is something like including in the agenda. On the basis of the discussion, they can ask certain resolution to be passed. They can propose a resolution which further can either be approved or rejected by other shareholders. Right to participate in key corporate governance decision. That is nothing but with respect to the board of directors, who should be on the board, who should not be on the board of directors, appointment and removal of directors. All that matters also, they have a say because they are going to vote at those resolutions. Right to adequate shareholder grievance mechanism. Very, very important. In private companies, their shareholders are internal members, a group of 5, 10, 15, maximum 25, 30, few group of people. You can solve their grievances easily. Limited number of members are there. But when you talk about a public, limited or listed company, you have crores of shareholders. If they have any issue, for example, maybe they have applied for share transfer, their application has not been processed. The shares have not yet been transferred. They have not received their dividend. They have not received their bonus share. They have not received the financial copies. For anything, the shareholder might have a problem. The shareholder might be facing an issue with respect to the shares of your company. In that case, whom are they going to contact? How are they going to get their problem solved? So within the organization, the company is required to create a stakeholder relationship committee who is going to solve any shareholder grievances. To address the grievance of these shareholders, we should have a separate department. In addition to that, the Securities Exchange Board of India itself has set up the scores mechanism. In case the company is not solving your problem, you can approach the scores mechanism. But within the organization, at the corporate level, at the company level, they are required to provide us a mechanism where the shareholders at large, from public at large, can get their grievances, their problems solved. So these are the various rights that the shareholders have as per the Companies Act and as per the provisions of the LODR regulations. So that is all about equity shares. Let's move to the second instrument, that is preference shares. You already have a basic idea about what are preference shares. Preference share is one of the two categories of the share capital of the company. First category or the basic category is equity shares, and second category is the preference shares. When we saw the definition for equity shares, we saw that any share that is not a preference share is a equity share. We saw that definition. We saw that example. Now, for that definition to become applicable, we need a clear-cut explanation of what is preference share. Clear-cut conditions that should be satisfied for being called as a preference share, because only if you don't fall under these conditions, only if you don't fall under this requirement, then you will fall under the ambit of equity shares. So for preference shares, we need to have a very, very specific definition that has been provided to us under the provisions of Companies Act, where they say that preference share is a part of the company's share capital. That we know that the share capital can have equity shares as well as preference share. Both can constitute share capital. It is a part of the share capital of the company where those shares are going to carry a preferential right with respect to two things. What are we saying? We are saying that the entire share capital can be split into equity shares and preference shares. Those category of shares which have some kind of preference, those shares which have some kind of preferential right, that means they have some kind of priority, they have some kind of preference, they are going to have some kind of upper hand in respect to a few matters. What are those matters? First one is with respect to dividend. They are going to get a fixed rate or fixed amount of dividend, or they are going to get repayment of capital in the case of winding up. They are going to have preferential right in comparison to the equity shareholders. If your share is going to give you some kind of priority, some kind of upper hand, some kind of superiority, some kind of preference when the dividend is going to be paid, some kind of preference at the time of repayment of capital, you are paid before any other shareholder is paid. That means we are giving you preference, and that category of share is going to be called as a preference share. So what is a preference share? Preference share is a part of the equity share capital of the company, where those kind of shares are going to have a preferential right with respect to two things. Both these preference, one is with respect to dividend. If you are going to get fixed rate of dividend, if you are going to get a fixed amount of dividend, we are going to say that we are issuing 10% preference shares. That means every year 10%, the dividend that you are going to receive is 10%. 10% preference shares, 8% preference shares. The rate of dividend is already predetermined. The amount of dividend that has to be paid is fixed. Then we say that you have a preferential right. We are giving you dividend before we are giving dividend to any other category of shareholders, that is equity shareholders. And at the time of repayment of capital, when we are winding up the company, after the creditors are paid, then we are going to pay the preference shareholders. After preference shareholders are paid, then the ordinary equity shareholders are going to be paid. So in comparison to the equity shareholders, the preference shareholders are going to get their capital repayment first. So they are getting a preferential treatment over other category of shares. So they are going to be called as preference shares, where they are given preference, they are given priority, they are given an upper hand. They are at an advantage at the time of payment of dividend. They are at a time of advantage at the time of repayment of the capital at the time of winding up, right? So this is about the definition of preference shares, where we say that preference share is a part of the share capital of the company, and these category of shares carry a preferential right with respect to dividend, where they are going to get fixed rate or fixed amount of dividend, and also at the time of repayment of capital, they are going to be paid first before the equity shares are going to be paid. So if you satisfy all this requirement, then that category of share is going to be called as a preference share, and if these conditions are not present, that means you are an equity shareholder. But now, even though even though we are giving preference to the preference shareholders at the time of dividend and at the time of repayment of capital, still there are certain drawbacks that are associated with preference shares because they have something called as limited voting rights. What do we mean? Let's quickly go back to equity shareholders' voting power. We saw that the equity shareholders have a right to vote. At which meeting? They have a right to vote at all the general meeting. Includes AGM and includes EGM. Annual general meeting as well as extraordinary general meeting. At all kinds of general meetings, they have a right to vote. Not only that, they also have a right to vote at all the resolutions that are going to be put before in the general meeting, right? That is the power of equity shareholders, right to vote at all the resolution placed before all the general meetings. But that scenario is not applicable for the preference shareholders because we are going to give them preference in some area. We are having to give some limited voting powers for them. Why is that? We give them the right to vote at the meeting of the members, but subjected to the condition that they can vote at only certain resolutions, at only certain specific resolutions. They are not permitted to vote for all the resolutions. Only those resolutions which are directly going to impact the preference shareholders, only those resolutions in which the preference shareholders are interested, only on those subject matters, only on those resolutions, they will have a right to vote. They do not have a right to vote at all the resolutions. That is the difference between equity shares and preference shares with respect to the voting power. Here the preference shareholders, even though they have a preference with respect to dividend and the repayment of capital, they do not have voting powers. They have limited or restricted voting power because they do not have a power to vote at all the resolutions. They only have a power to vote at certain resolutions where they are directly interested. So let us see, there are certain drawbacks of the preference shares, that is limited voting power. The preference shares carry voting right only with respect to those matters which directly affect the rights of the preference shareholders. It does not have a lot of control over the company because their voting right power in company is equal to votes. If you have more votes, you have power in the company. If you are not allowed to vote only, how are you going to control the company? So yes, the preference shareholders do not have a lot of control within the organization. They cannot vote on all the matters that are placed before the meeting of members. Only equity shareholders have that right. The preference shareholders are restricted to vote only on those matters in which they are directly going to be impacted. But the most important thing to be note here is, at certain given scenarios, the preference shareholders are going to be treated at par with equity shareholders in relation to the voting power. Generally, there is a difference. We know that preference shareholders are given preferential right with respect to two things. I'm not talking about that. When I'm talking about equality between equity shares and preference shares, I'm talking with respect to the voting power. That means even the preference shareholders will have a right to vote on all the resolutions which are going to be put forth in every general meeting, but this is subject to only one condition. This will become applicable only when the company makes a default in the payment of dividend. If the preference shareholders are not getting the fixed percentage of dividend that has been promised, fixed rate of dividend is not being given to them. You are giving them the preference. We are giving you preference with respect to dividend. We are going to give you so much fixed amount of dividend, but actually you are not giving it to them. Then what is the element of preference? You have only told it, but you are actually not executing. There is some kind of default with respect to preference shares by the company. So when such default continues, the preference shareholders will also acquire the voting rights that the regular ordinary equity shareholders have. So only when the company is going to default in the payment of dividend of preference shareholders, shareholders, they also will get the voting rights as that of ordinary equity shares. So a preference shareholder may acquire the voting rights on par with the equity shareholder if the dividend on preference share continues to be in arrears. The company is not giving the preference dividend, then even the preference shareholder will have a right to cast his vote on all the resolutions just like a regular equity shareholder can. Okay, so let's move to the next concept, that is the different categories of preference shares. The preference shares can be classified on different subject matters into different areas. First one is on the basis of accumulation of dividend. Now, what do we mean by that? Now, we all know that preference shares are those shares in which we are going to give him the preference with respect to dividend. That means we are going to tell him you are going to have a fixed percentage or fixed rate of dividend. We have issued 8% preference share. In that case, he knows that every year he is to receive a dividend. That is the promise that we have given. That is why we made an issue of preference shares. We have promised him that we are going to give him a fixed rate of dividend, but the company does not give the dividend. Then what is going to happen? First situation, he is the preference shareholder, okay, and he is required to get a dividend. Every year he is required to get a dividend. In the first year, they have issued the dividend. He has received the dividend. In the second year, they have not given the dividend. In the third year, they have given the dividend. In the fourth year, they have not given the dividend. In the fifth year, they have not given the dividend. Okay, this is the scenario. Now tell me, in the third year, when they are giving you the dividend, should they give you the dividend only for the third year, or even the second year's dividend is required to be paid? Is this shareholder, preference shareholder, entitled to receive the dividend that was not paid in the previous year? What is going to happen? For this, we have a classification. We classify the preference shares on the basis of accumulation of dividend into two categories. One is called as cumulative preference share and second one is called as non-cumulative preference share. One is cumulative, second one is non-cumulative. What is the difference? If you have a cumulative preference share, cumulative means adding up. You can also call it as carry forward, just to remember that it has to be paid in the consecutive years. Cumulative means it is going to pile up. All the dividend that is unpaid for any year is going to pile up and has to be paid. For example, he is the preference shareholder. In the first year, he has received the dividend. In the second year, he has not received the dividend. In the third year, he has to get for the second year as well as the third year. Till he does not get the dividend, that is going to add up. It is going to keep on accumulating. It is going to add up. Ultimately, the entire sum has to be paid to you at the time of redemption. That is cumulating. It is adding up. It is going to be carried forward for the next year. You had to receive it today. You have not received it. You are entitled to receive it in the next year. That is cumulative preference shares, where you have to mandatorily get the dividend for every year of your preference shares existence. Even in 1 year, if you don't get it, you are entitled to receive the dividend for that unpaid year in the next following up year. And next one is non-cumulative preference share. Non-cumulative is exactly opposite. That means there is no adding up. If in the first year you have received it, well and good. In the second year you have not received it, please forget it. Because you are a non-cumulative category preference shareholder. If you have not received in the second year, you are not going to get it in the third year. In the third year, we are only going to focus on the third year. If they are going to give it, they are going to give only for the third year. The second one, please forget. Because it is a non-cumulative preference share. You are not entitled to get the dividend if it is not declared in a particular year. If it is not given in a year, you are not entitled. Please forget it and move forward. Carry forward is not permitted. We are not going to add up. We are not going to pile it up. If it is lost, it is lost. In 1 year preference dividend is not paid, it is not paid. Next year is a fresh year. We are not going to add up. We are not going to carry forward the dividend that has to be paid. This is the classification of preference share on the basis of accumulation of dividend into cumulative preference share and non-cumulative preference share. In cumulative preference share, the dividend is accumulated. If it is not paid, it is going to be added up. It is going to be piled up. It is going to be carried forward till it is not cleared off. In case of non-cumulative preference share, the dividend lapses if it is not paid. Please forget it. If it is not paid, it is lost. You are not going to get it. It is lapsed. Next year is a fresh year, and if the dividend is going to be paid, it is paid. If it is not going to be paid, it is not going to be paid. There is no piling up. There is no adding up. So that is first category of classification for preference share. Second category of classification is on the basis of convertibility into equity shares. What do we mean by convertibility? Converting an instrument, we are going to convert. So there are two things that are possible. We all know that preference share is going to come with the maturity period. It is going to come with the redemption. At one point in time, the preference shareholders are going to end. The preference share capital is going to end. It is going to have an end date. At that end date, the preference shareholders have two options. One is redemption. What is redemption? That is your principal investment, the principal amount that you had paid, the capital that you had given as a preference share capital, that can be given back to the shareholders in the form of cash. So they are going to get back the principal investment that they had made. And other option is conversion. What is conversion? Conversion is nothing but your preference shares are going to be converted into equity shares. That means you're not going to get back the capital that you had paid. Let's assume that this particular shareholder had given 1 lakh rupees as capital, and he's made an investment in preference share capital. So on conversion, what is going to happen? 1 lakh is of preference shares are going to be converted. Value I'm telling, rupees 1 lakh equated rupees 1 lakh equity share capital. Depending upon what is the value of one equity share, we are going to determine how many number of equity shares are required to be given to this preference shareholder at the time of conversion. So total capital equivalent number of equity shares are going to be given to the preference shareholder. We are converting the preference shares into equity shares. So whatever capital is there, it is going to move from preference share capital account to the equity share capital account of the company. The value is going to be same. For the equal amount of rupees, we are going to give equity shares. How many equity shares are going to be given? That is going to be determined solely on the market price of the equity share. Value of equity share is going to determine how many shares are going to be given, right? So what are the two options available at the time of whenever preference share comes into picture? Two options are there. One is redemption. Redemption is whatever principal capital amount you had invested, 1 lakh in this given scenario, you are going to be given 1 lakh and you can exit the company. That is redemption. And conversion is you're not going to give any kind of cash. Instead of preference shares, we are going to issue you equity shares. Equal amount of equity shares are going to be given to you. What about the return now? Tell me. So whenever we talk about preference shares, they are entitled to a fixed rate of dividend. So that dividend will be paid on yearly basis, quarterly basis, whatever is the terms and conditions. You've already received the return part. So we are here only talking about the principal investment that has been made. So now on the basis of classification of convertibility, preference shares are either convertible or non-convertible. Convertible means those shares can be converted into equity shares at the time of redemption. Non-convertible means we are not allowing you to convert into equity shares. You have to mandatorily take your principal investment and exit the company. We are going to put a dead end to the preference shareholders. That money is not going to move from preference share capital to equity share capital. So what are the two kinds of preference shares in relation to convertibility? One is convertible preference share, where the share can be converted into equity share at the time of redemption, and second one is non-convertible preference shares, where the shares cannot be converted to equity shares on redemption. They have to take the amount and exit the company. So that is on the basis of convertibility. And third one is on the basis of participation in the surplus profits or surplus assets of the company. Now, on the basis of this, we have two. One is participating preference share and second one is non-participating preference share. Means, are you permitted to get share in the profits? What is dividend? Dividend is also share in the profit. For preference shareholders, we have already given a fixed rate of dividend. We have decided a percentage of dividend that we are going to give you. Over and above that, are they entitled to get in extra, whatever surplus is there with equity shareholders? Can they also get extra profits? Can they share the profits of the company over and above the dividend that has already been promised to them? For that, you should see what is the category of preference share that has been issued. If it is a participating preference share, over and above the dividend that has been promised to you, you will be allowed to take part in the other remaining profits of the company as well, where they will be entitled to receive profits over and above the dividend that has already been promised to them. And non-participating preference shares are they are only eligible to the fixed rate of dividend that has been promised to them. Over and above that, not even a single rupee is going to be given to them. Even if there is extra profit, we are not going to pay the preference shareholders because they are non-participating preference shares. Okay, so this is the classification of preference share on the basis of accumulation of the dividend, on the basis of convertibility, and on the basis of participation in the surplus profits. So it is the choice of the company what kind of preference shares they want to issue. They can issue cumulative, non-convertible, participating preference shares. They can issue non-cumulative, non-convertible, non-participating preference shares. So all this is going to be determined in the terms and conditions of the issue of preference share. So you should read what is the category of preference share that is going to be issued by the company. Earlier, there was one more fourth category of classification on the basis of redemption. Redeemable and irredeemable preference shares. That means redemption means you are going to have a fixed maturity date, that we are going to issue preference shares for 10 years. After 10 years, the maturity is going to take place. That is redemption. Irredeemable means you were never allowed to, that was permanent, like equity share, even preference share was permanent. No maturity date was given by the companies. But now the laws is clear that the preference shares can only be redeemable. You cannot issue any irredeemable preference shares. So that category has been removed because there is no classification. It always has to be redeemable preference share. That means any preference share that is going to be issued is required to have a fixed period of redemption. You should tell them at what point in time they are going to get an option of redemption, or at what time they are going to get an option of conversion into equity shares. So this is the classification of the preference shares. Okay. Next. So types of preference shares. The issuer desirous of making an offer of non-convertible, redeemable preference shares to the public is required to list at one or more recognized stock exchange. So they say that just like equity shares are listed on the recognized stock exchange, the stock exchanges are also permitted to list the non-convertible, redeemable preference shares on the stock exchange. We have specific regulations. Those regulations are going to become applicable. It may also list its non-convertible, redeemable preference shares on private placement basis on the recognized stock exchange. So yes, here on private placement basis, only to a selected group of people we are going to make a public issue. Here public at large we are going to make an issue. Both are permitted. So yes, the companies are permitted to raise preference share capital from the public at large and list their preference shares even on the stock exchange, but that is restricted. It has to be non-convertible and redeemable. Non-convertible means at the end the option of conversion is not given, and plus redeemable means it is going to have a fixed maturity period. On that day the redemption is going to take place. Okay, so that was all about the preference share. Let's move to the third instrument, that is debentures. By the name itself, you can identify that this kind of instrument is a debt instrument. A lot of students pronounce the word as debt. B is silent, it is debt. The alphabet B is silent. It is debt, okay? It is a debt instrument. That means some kind of loan, some kind of borrowing is going to be associated, which has to be paid back after a certain duration and time. And whenever we associate loan and borrowing, we also associate one word, that is interest. We are going to give loan because we are expecting something in return, and that return is interest. Like in preference shares, in equity shares, we are going to get something in return, that is dividend. But when you are going to give a loan, when you are going to make an investment in debenture, you are not going to get a dividend. You are going to get something called as interest on your principal amount, on the capital that you have given them. On that capital, you are entitled to receive something called as an interest. So debenture is a debt instrument that signifies some kind of debt, it signifies some kind of loan, it signifies some kind of borrowing on which the investor is entitled to receive return in the form of interest. So let's see what are debentures. Debentures are documents. It is an instrument that you have given some amount of money. What? Signifying or evidencing the debt or acknowledging it. We are signifying, we are communicating by giving you an instrument that yes, we have borrowed 1 lakh rupees from you. Yes, we are acknowledging that you have given us 1 lakh rupees as capital for us in the form of debenture. We have received the amount from you. So any document that acknowledges that a debt has been created, some kind of loan is there, some kind of borrowing is there, that instrument itself is a debenture. So debenture is any document which is acknowledging, which is evidencing the creation of a debt, creation of a loan, creation of a borrowing. Let's see what is the actual definition for the term debenture as per the provision of section 2 subsection 30 of the Companies Act 2013. They say debenture includes. So they have not given as such the definition. They have given a list of what is categorized as debenture. Any debenture stock, bond or any other instrument of the company which is going to create an evidence of debt, whether a charge is created or a charge is not created. So what are they telling here? They include 3 things, predominantly 2 things. One is debenture stock and second one is bond, and third one is miscellaneous. In future also, if any instrument is going to be issued by the company which is not referred to as any name, but it is acknowledging some kind of debt, that is also going to come under the definition of debenture itself. So debenture includes a debenture stock, it includes a bond, and it includes any other category of instrument in the company which is going to act as an acknowledgement for the debt that has been created. And the most important thing is whether a charge is created or charge is not created on that instrument, irrespective of that, it is going to be a debenture. That means it can either be a secured debenture or it can be an unsecured debenture. Either it can be a secured loan or it can be an unsecured loan. When we say that we have created a charge on our asset, that means it is a secured asset. It is a secured debenture. We have created a charge. We have allotted some kind of asset for this particular debenture. You have given us a loan. You have given us a debenture amount. Now, in security to you, we are telling that because we have borrowed rupees of 1 lakh from you, we are required to pay you back after 5 years. Till then, for this particular loan that we have created, the loan that we have taken from you, the borrowing that we have taken from you, we are going to give you this asset as collateral security. In case at the end of 5th year we fail to pay back the debenture amount, we fail back to give you the amount that we have taken from you, you can use the asset that we have given as collateral to recover the amount that you have to from the company. So secured means some kind of asset is allocated for your loan. We are creating a collateral. We are assigning one specific asset only for your loan. In case we default to pay the money to you, you can use that asset to recover the money that is due from the company. That means a charge is created. We have attached one loan with one asset. In case the loan repayment is not done, this asset can be used to repay the loan. That is secured debentures. Unsecured means we are not giving you any kind of guarantee, no collateral, no assets are attached. It is a risk. Right? So, if a charge is created, it is a secured debenture. If a charge is not created, that means it is an unsecured debenture. So, what is debenture? Debenture is any kind of instrument, any kind of document which acknowledges that there is a debt, which acknowledges there is some kind of borrowing, and that can be either a secured borrowing or it can be an unsecured borrowing. Next. What are certain features or characteristics of debentures? First and foremost is a certificate of indebtedness. That means a debt is created. We have to pay you after so and so duration. That has been acknowledged in that certificate. That is the first characteristic. Second one, it indicates the period of redemption. Like I told you, you are going to have a fixed maturity. The date is going to be provided. What is the duration? It is for 5 years, it is for 10 years. What is the exact date when we are going to repay back the money to you? That is going to be fixed in case of debentures. Repayment of principal and interest is on a fixed dates. Principal is going to be paid back to you only after the final maturity. But the interest, whether it is quarterly, half yearly, annually, that has to be determined. If it is quarterly, what is the date when we are going to pay? If it is annually, what is the date when we are going to pay? All those things are going to be predetermined. You are going to have fixed date of payments for interest as well as for the principal amount at the time of maturity. Interest to be paid even if the company does not have profits. Most important thing, the equity shareholders are going to get the returns in the form of dividend only if the company is going to make profits. If they have surplus, they are going to share with the equity shareholders. If they are making loss, how are they going to share dividends? They are not going to get anything in the form of dividend as returns. Preference shareholders, if it is cumulative, they will get at some point in time. If it is not cumulative, they are not going to get if there are no profits. But in case you have made an investment in a debenture, irrespective of whether the company is making profit or the company is making a loss, you are entitled to the fixed rate of dividend that they have promised. Even if the company is making losses, they have to pay you the fixed rate of interest because it is in the form of a loan, it is a form of a borrowing. You are entitled to get the interest even if the company is making losses. For secured debenture, the charge on asset will be created. If you are making an investment in a secured debenture, a collateral is going to be there, a charge is going to be created for the debenture issue, and in case the debenture redemption is not done, that asset can be used for recovering the particular amount that is due. And lastly, the debenture holders do not have any voting rights. They are not the owners of the company. They are not the members of the company. They are not the shareholders of the company. They are only people who are going to be treated as creditors of the company, and creditors will not have any right or say in the ownership. They have no control over the organization. So we are not going to give them any voting right, not even one single vote they are going to have at the time of general meeting member. They are not allowed to vote at the general meeting meeting of members because they are not considered as members of the company itself. So they do not have any voting rights in relation to the company. So these are the few characteristics of debentures which are issued under the Companies Act. Let's look at the categories of debentures. So the debentures can be classified on various bases. Specifically, let's talk about on the basis of convertibility. Like we could convert preference shares into equity shares. Similarly, the debentures can also be converted into equity shares. Let's see what are the various categories of debentures. Fully convertible debentures. Fully convertible debentures means if you have rupees 1 lakh as your debenture principal amount, equally rupees 1 lakh worth equity shares can be given to you. Fully, whatever amount is there, full equivalent amount of equity shares are going to be given to you. Non-convertible debentures, that means you have no option of conversion. No conversion. You have to take the 1 lakh rupees in cash and exit the company. Conversion is not permitted. No equity share is going to be granted to you if it is a non-convertible debenture. You have partly convertible debenture. Partly convertible debenture is, let's assume that you have made an investment of 1 lakh, and out of this 1 lakh, you can take 50,000 rupees in the form of equity shares, and you can take 50,000 rupees in the form of cash. Partly, part conversion is permitted, part redemption is permitted. So where redemption and conversion both are the terms and conditions, then we say it is partly convertible. It is your choice. Half you're going to convert, half you're going to take redemption. That is partly convertible. A part of your investment can be converted into equity shares. And optionally, fully convertible debenture. Optionally, fully convertible debenture. That means we are giving you an option. What is the option? Option is whether you want redemption or you want conversion. If you want redemption, you should take 100% redemption. If you want conversion, you should take 100% conversion. But the choice is yours, whether you want for redemption or you want for conversion. Here, no option. Conversion has to be done. Here, no conversion. Second one, we are not giving you an option. In the terms and condition itself, we have specified non-convertible. Redemption means only redemption is possible, conversion is not possible. Convertible, only conversion will be done, redemption is not possible. Here in the fourth category, we are giving you an option. Do you want redemption or do you want conversion? But if you select redemption, 100% you should opt for redemption. If you select conversion, 100% you should go for conversion. And the last one is optionally, the partly convertible. Out of that amount, partly can be converted, partly can be redeemed. So predominantly, these are the four categories of debentures. Let's look into each one of these categories. First one is fully convertible debenture. That means if you have 1 lakh worth debenture, okay, you will get equity shares. The value of equity share is going to be 1 lakh. But how many number of equity shares you are going to get, that is again determined on the price per share. If the value of one equity share is 10, or if the value of equity share is 100, determined on the basis of the price of equity share, you are going to determine how many number of equity share is going to be given you for the 1 lakh rupees that you have given. Right, so that is correlation, and how much you will be given, that is totally dependent upon the price of equity shares. But the value of investment is going to be the same. Instead of 1 lakh debentures, now you are going to have value worth 1 lakh of equity shares. Value is going to be same. The number of equity shares that are going to be allotted is on the basis of value of one equity share. So that is convertible. When we are converting the debenture into equity share, these are called as the convertible debentures, and it is fully convertible means 100% conversion. Converted to equity shares on the expiry of a specified period, that is at the time of redemption, at the time of maturity, we are going to, instead of giving you cash, we are going to move the amount from the debenture account to the share capital account, equity share capital account. We are not going to give you back the principal amount. Instead of giving you the principal amount, we are going to hand you over equity shares of the company. It can be converted into equity shares at a premium or without a premium. The terms and conditions is going to be determined. Okay, depending at what is the value of one equity share, we are going to determine how many equity shares you are going to be given. It can be at premium, it can be without premium. What is the price to be considered, that is going to be according to the terms and conditions. If duration of conversion period is given in a range, it is the option of the debenture holder about when he wants to convert. What do they mean? They mean that, let's assume that the debenture was issued for a period of 10 years. Okay, the maturity period is after 10 years. But in the terms and conditions, they've said that after the 5th year, you can convert at any given point in time. You can convert at any given point in time. Then it is the option of the debenture holder whether he want to convert at the end of the 5th year, whether he want to convert at the 6th year, he want to convert at the 7th year, or till the 10th year only he wants to do the conversion. That becomes his choice. If we are telling that you can convert at any given point after this date, then the option is of the debenture holder when he wants to opt for conversion, whether he wants to complete the entire maturity period as a debenture holder, or immediately when the conversion option is given, he is going to opt for conversion. That is going to be his option. Let's take an example. If conversion has to take place on or after 18 months from the date of allotment, but before 36 months. So they've said that today we are going to we have made an issue of debenture. We have issued the debenture. You can continue to be the debenture holder, but between the duration of 18 months and 36 months, during this time, at any point in time, you can tell that I want to convert into equity shares. I want to become an equity shareholder now. They've given between this time only you should make an application for conversion. Then it is the option of the debenture holder whether he want to convert on 18th month, 19th month, 20th month, 32nd month, 36th month. That is his choice. We have given them a range. Within that range, whenever they want, they can apply for conversion. So in this case, the debenture holder can decide between 18 to 36 months when he wants to execute the actual conversion of his debentures into equity shares. If the conversion period, if any time between 18 and 36 months, it is the choice of the debenture holder about when he wants to convert it, but conversion is mandatory. It is fully convertible debenture. You have to mandatorily convert your debenture into equity share. But when you are going to convert is the question, and that becomes your choice when the company is going to give you a range. If they have not given you a range, that means only on maturity you can convert. But if they have given you a range, in that range period, you have to apply for conversion, and whenever you want, you can apply. In such a case, the interest of debentures will be paid only till the date of conversion. Very, very important and common sense. What are we telling here? We have made an issue of debenture, and those debentures are convertible into equity shares. This is the same basic concept. On debentures, we are earning something called as interest because it is an acknowledgement of some kind of debt. Here we are talking about equity share, which signifies some kind of ownership. And because you're owner, you're entitled to share the profits and you're going to get the returns in the form of dividend. Now, when you're talking about first category of the dividend, which is 100% convertible, fully convertible, in that case also you have two categories where duration is subjected to the choice of the investor and where no choice is given. Where no choice is given, no problem. At the end of maturity period, only we are going to do the conversion. So he is going to continue to be the debenture holder till the end period, and then he is going to be converted into equity shareholder. No problem arises. But when a particular choice is given, a duration is given, that between 18 months to 36 months, whenever you want, you can apply for conversion. Let's assume that we as a debenture holder, we have made an application for conversion on the 20th month. At the end of 20th month, we have made an application for conversion into equity shareholder. Now, the entire duration is not completed. So, in that case, will we continue to be a debenture holder for the entire maturity period, or as soon as we apply for conversion, our designation is going to change? As soon as we apply for conversion, at the end of 20th month, only till the 20th month, from the first month to the 20th month, we are going to be called as a debenture holder. As soon as our debentures are converted into equity shares, from the 21st month, we are going to be designated as equity shareholder, and we have nothing to do in relation to debentures. So we will not be entitled to receive any kind of interest, but we will convert ourselves into equity shares, and if any dividend is going to be declared, we will be entitled to receive those dividends. So what do they say? As soon as you apply for conversion, even if there is some duration for maturity of debentures, you are not going to earn interest on that, because before that only you have changed your designation from a debenture holder to the equity shareholder. So only till the date of conversion you are going to get the interest as a debenture holder. Once your instrument is converted from a debenture to an equity shareholder, you will not be entitled to any interest, but your designation is changed, so you may be entitled to dividend. It is going to be declared by the company. So that is fully convertible debentures, where 100% conversion is mandatory. If a range is not given, it is going to be converted at the end of maturity period. If the company is going to give you a duration, it is your choice when you want to apply for conversion. From the date you apply for conversion, from the date it is converted into equity share, your designation is going to change. So you're not entitled to earn any interest after the conversion takes place. So that is the first category of debenture, that is fully convertible debenture, 100% mandatory conversion into equity shares. Next, same thing, they have given an example. If Mr. A has made an investment in convertible debentures of XYZ for a value of 1 lakh on maturity, he will get equity shares worth 1 lakh rupees itself, but the number of shares that he will get will be based upon the conversion price. What is the price of one equity share? On that basis, we are going to determine how many equity shares. Suppose the conversion price is 500. He is going to get 20 equity shares. He has total value of 1 lakh rupees and the value of one share is 500. So he is going to get 200 equity shares in return for those debenture investments that he had made. Second category of debenture is non-convertible debenture. Non-convertible means we are not going to convert into equity share. Only one option is there, and that option is redemption. Redemption means whatever cash is there, whatever capital contribution you have given, whatever principal amount you have given, that principal amount is going to be paid back to you. Principal is going to be paid back to you. The interest will not be paid, because periodically the interest will be given to you. So here we are only talking about getting back the principal amount of investment. That principal amount of investment is going to be given back to you in redemption in case of non-convertible debentures, because we are not converting it into equity shares. So they do not carry the option of converting into equity shares. Therefore, they have to mandatorily be redeemed on the expiry of the specified period or maturity period, and the issuer is required to list its public issue of non-convertible debentures on stock exchange as per the requirements, and it also do on private placement basis. Similarly, like we did, the non-convertible redeemable preference shares were permitted to be listed on the stock exchange. Similarly, non-convertible debentures could also be listed on the stock exchange. Next. For example, if Mr. A has made an investment of convertible convertible debentures of XYZ Limited for a value of 1 lakh rupees on maturity, he will get back his principal investment of 1 lakh in cash transferred to his bank account. So this is non-convertible. There is an error. So if he has made an investment in non-convertible debenture, he is going to get back his cash in his bank account and equity shares will not be given to him. That is non-convertible. 100% whatever principal investment you had done, you are going to get back that money into your bank account. That is redemption of your debentures. Next, partly convertible debentures means option, half conversion, half redemption, right? These may consist of two kinds, namely convertible portion to be converted into equity shares at the expiry of a specified period, and non-convertible portion which has to be redeemed. Same thing that I have told. Partly it is going to be converted, means you are going to get some number of equity shares for some value, and partly you are going to get the amount in your bank account. So the principal amount of investment that you had given in the debenture, that amount partly you are going to get equity shares and partly it is going to be transferred to your bank account. Now, for the convertible portion, if the conversion takes place at or after 18 months, the time of conversion is optional at the discretion of the debenture holder. Same what applies for fully convertible. If they have given a duration of convertibility, you can decide when you want to convert. At that point, we are going to change your designation to the equity shareholder. And for the redeemable portion, again, for what value you are redeeming, that for that value we are going to pay the interest. For the converted portion, we are not going to pay any interest. Now, To simplify it, the entire thing is going, your entire principal amount, your entire principal investment. And which investment is? This investment that you have made in debentures. Your principal amount in debentures is going to be split into two portions. First one is convertible portions. That means you're going to get equity shares in exchange for this amount of debenture. In relation to the second aspect, that is non-convertible portion, you are going to get the amount back into your bank account. You're going to get back the cash. To be converted into equity shares at expiry of a specified period, again if a range is given, within that range or at the time of maturity, they are going to convert and give you equity shares. Here it to be redeemed at the expiry of a stipulated period. A time will be given, at that time redemption is going to take place and the amount is going to be transferred to your bank account. For this convertible portion, till your conversion is not done, you're going to get the interest. As soon as the conversion is completed, you're not entitled to be called as a debenture holder with respect to that portion which has been converted, and you will not be entitled to get any interest. You will get dividend in relation to those category of investment. Next. If Mr. A has made an investment in convertible debentures of XYZ Limited for a value of 1 lakh on the basis of terms and conditions of issue, he can split this 1 lakh into, for example, 40,000 rupees he can apply for convertibility of equity shares, and 60,000 he can consider as non-convertible portion. So worth 40,000 rupees he is going to get equity shares, and worth 60,000 rupees it is going to reflect bank into his bank account. He is going to get back the cash. So this is the convertible portion. This is the redeemable portion. He can split his investment, half it into conversion, half into redemption, or whatever ratio is there according to the terms and conditions. According to that, split will be done. Certain portion is going to be converted into equity shares. Certain portion is going to be redeemed in your bank account. Next. Last category of debenture is optionally fully convertible debentures. So here the option is whether you want to go for redemption or you want to go for conversion. If you want to go for redemption, 100% redemption. If you want to go for conversion, 100% redemption, conversion, right? So here it is not about whether we are converting or we are redempting. It is not about what is the outcome. Here choice is given to the holder itself. You decide whether you want conversion or you want redemption, because till now, before this, fully convertible, mandatory conversion, non-convertible, mandatory not convertible, right? So there the terms of issue had decided whether conversion will be possible or the conversion will not be possible. Here that is not the outcome. Here we are leaving it to the choice of the investor. You tell us whether you want redemption or you want conversion. But if you select conversion, 100% conversion. If you select redemption, 100% redemption. If he opts for conversion, he should convert the entire principal amount into equity shares, and if he opts for redemption, he should go for entire investment to be converted into the value, right? So it is his choice whether he wants to go for conversion or redemption, but whatever he chooses, that is the only option for the entire value of investment. That is what is going to be the outcome, either conversion or redemption. Same thing. Option is going to be given to the debenture holder whether he wants to convert into equity share or he wants to get the principal amount of investment. Only the condition that is applicable is fully converting his debentures. We are not going to give any option of redemption. 100% conversion should be done, and converting at a predetermined price. So the price of equity share, per equity share price value is going to be predetermined according to the terms of issue, and the conversion or expiry of a certain period. When conversion is required to be done, that is also going to be decided. In case of redemption, fully redemption, 100% of the value of debenture are required to be redeemed. That means the value is going to reflect in your bank account. We are not going to give any equity share in exchange of that debenture. So here option is whether you want conversion or you want redemption. That is left to the choice of the investor. That is optionally fully convertible debenture. So we are giving you an option of conversion, but you should fully convert it. But it is also your choice that you can go for full redemption. Optionally fully convertible debenture is also called as a hybrid security because it has the characteristics of both debentures and equity shares. Because if you opt for fully convertible, if you opt for conversion, 100% conversion will be there. So your debenture is converted into equity share, so you're going to have the features of equity share. But if you go for redemption, 100% redemption, forever from the beginning till the end, you're only having the characteristics of a debenture. So it is a combination of debenture and equity share shares which is left to the choice of the investor. That is why we call it as an hybrid security, because it carries the feature of both debentures as well as equity shares along with it. So these are the four predominant classifications of the debenture, that is fully convertible debentures, non-convertible debentures, partly convertible debentures, and optionally fully convertible debentures. I hope that is clear. Now let's move to the fourth category of instrument. Till now we have covered equity shares, we have covered preference shares, we have covered debentures. This is the fourth category of instrument, that is bonds. Where have we come across this term bond? When we saw the definition of debenture, we saw that debenture includes debenture stock and bonds. So what is bond? Bond is a kind of debenture. It is a debenture. It is a category of debenture. Again, that means it is a debt instrument. You are going to earn interest on this debt that has been created in the form of loan or borrowing. It is just that certain features are going to be different, right? Let's see. Bonds are also debt securities. Issuer is bound to pay the specific rate of interest and repay the principal amount at the time of maturity. Yes, periodically you are going to earn your returns in the form of interest, whether it is quarterly, half yearly, annually, whatever is according to the terms and conditions, and thereafter at the time of maturity, the entire principal value that you had contributed, you are going to get back that principal amount. It is the same thing of how debenture works. The bond holders are like creditors to the company, and the company is mandatorily obligated to pay them. They are like creditors of the company. You have to pay. It is like a loan, it is like a borrowing. You have to pay back the bond amount, principal amount that you have taken. And the people who are purchasing bonds are called as bond holders. People who purchase equity shares are equity shareholders. People who purchase preference shares are preference shareholders. People who buy debentures are debenture holders. People who buy bonds are bond holders. And these bond holders are creditors of the company who are mandatory obliged to get the payment back for the loan that they have given. The bonds will generally have a fixed maturity date. Similarly, you're going to have a fixed date. On 27th January 2029 is the redemption date. On that day, you're going to get back your principal amount. The interest periodically you have earned. The returns you have earned on a significant duration. For that 10 years duration, you have got the interest on quarterly basis. So the returns you have already got. The principal capital amount you're going to get back only at the time of maturity, at the time of redemption, on the fixed maturity date that is going to be specified at the time of issue of those bonds. For example, some examples of bonds I have taken. HUDCO, that is Housing Urban Development Corporation, has issued N5 series. The duration of bond is 15 years. The maturity date is February 2028 and the interest that they are providing is 7.51%. Okay, that is the interest rate for the bond. One more, National Highway Authority of India has launched N6 series, that is again duration is 15 years. It is going to mature on February 2029 and the interest that they are providing is 8.75%. So these are few examples of bonds that are issued by government authorities. Similarly, corporate bonds are also there. Even companies can issue bonds. Okay, now let's see a few characteristics of bonds. First one, it is going to have fixed face value that has to be returned on maturity. So they are going to have fixed value, like one share value is 10 rupees. Depending upon how many rupees you are going to contribute, we are going to determine how many shares you are going to get. Similarly, even for bond, the value of one bond is going to be fixed. We are going to have a fixed value. One bond is 10,000 rupees, one bond is so and so rupees. So depending upon what is the capital you are going to contribute, we are going to determine how many bonds you are going to get. So it is going to have a fixed face value. Like one value of equity share is 100 rupees, 200, like that bond is also going to have a fixed value. Second one, and that value, your principal amount of investment is going to be given back to you at the time of maturity. Second one, it is fixed date of maturity. It ranges for few days to a few years. Generally, the government bonds which are issued for a longer duration, 12, 15, up to 20 years also bonds are there. Repayment of principal on maturity. Your interest you are going to return, get a return on a periodic basis, but your principal amount of investment that you are going to make, you are going to get back only at the time of maturity, that is 20 or 30 years later. Fourth one, regular payment of interest. That is I told, according to the terms and conditions, either it can be quarterly, half yearly, annually, whatever is the terms and conditions, according to what is your principal amount of investment that you have made. On that basis, according to the interest rate that is fixed, periodically amount is going to be given to you over a given duration of investment. Next, interest is calculated as a percentage of face value, that is coupon payment. For example, that we took here, the interest rate is 8.75%. If you have made an investment of 1 lakh rupees, 1 lakh rupees 8.75% interest rate is going to be given to you in your account. Next, less risky when compared to equity shares. You have a fixed rate, maturity period is fixed, right? So you have lesser risk associated when compared to the equity shares. And last, it helps to diversify and grow the investors' money. So rather than putting all your money into the equity segment, you can also put your money for the purpose of diversification in debt instruments like bonds. Bonds could be corporate bonds or government bonds, but the government bonds are more safer when compared to the corporate bonds. Now, coming to the different categories of bonds, bonds are classified into government bonds. These are the bonds which are issued by the government authorities, like we saw, National Highway Authority of India, you have tax saving bonds, you have the housing corporation bonds, so different electricity bonds. So every department have a right to raise money for the purpose of raising capital. They can issue bonds. So if any government or public sector undertaking is going to issue a bond, it is going to be called as a government bond. It is going to be secured because it is going to be backed by security which is given by the government. Low rate of interest is going to be given when compared to other category of bonds because it is issued by the government, plus it is secured. So when there is security, the rate of return is going to be less. The more the risk, the higher the return. So here the risk is very less because you are borrowing it from the government. You have given the money to the government, plus it is also secured by the government assets. So obviously the risk is slightly lesser. Because there is less risk, the interest that you are going to get is also lesser when compared to other category of bonds. Second kind of bonds is corporate bonds. Corporate bonds, by the name itself, you know the issuer is going to be the government companies, private companies. Again, these category of bonds can either be secured bonds or unsecured bonds, and it is very important that before you make an investment in corporate bonds, you should check the credit rating and credibility of the issuer, whether they are in the capacity to pay back the amount to you or not. Before doing that credit rating check, please don't make an investment in corporate bonds. Third category are the bonds which are issued by banks and financial institutions. This is issued by banks and financial institutions, and majority of the bonds which are issued are from this particular segment. And lastly is tax saving bonds. If you come under the income tax slab, if you are liable to pay income tax, if you are making an investment in tax saving bonds, that much amount of deductions are going to be permitted. So it is issued by the Government of India for providing benefit for investors in the form of tax saving schemes. Benefit is interest you are getting on periodic basis. In addition to that, you are also able to save the tax because you are eligible to certain kind of deductions, and it is also listed on NSE and BSE, and so it can be easily liquidated. So these are the four category or types of bonds which are there: corporate bonds, the government bonds, tax saving bonds, and banks and financial institution bonds. You are going to get practical and numerical problems on concepts related to bonds. So let's quickly look into it. On maturity, so what is the problem? What are they going to ask you? We all know, similar to how debenture works, bonds are also going to work in the similar fashion. Either you're going to get redemption or you're going to get equity shares, right? So you have to determine what is beneficial. What is the benefit for the investor? Should he go for conversion or should he go for redemption? This is the decision that you have to give in the practical problem. On the basis of numbers that they have given, you should do the calculation and you should tell what is beneficial for the investor. Should he go for conversion or should he go for redemption? That is what you have to tell, right? So on maturity, option available for the bond holder is option A, either to convert his bond into equity share, or option B is redemption of bond, that is you're going to take back the entire principal amount and keep it in your bank account. These are the two options. Now you, on the basis of your calculation, should tell what is beneficial for the investor. For example, let's take one question. To determine whether an investor should select option A or option B. So we are seeing how we are going to reach at the conclusion. Okay, what is option A? Option A is conversion. Option B is redemption. Okay, we have to decide at it. How are we going to reach at that decision? For that, we have to draw a comparison. We are going to be given two prices. One is conversion price and one is market price. One is conversion price and one is market price. What is conversion price? Conversion price is the price according to the terms and conditions of the bond issue. That means they are going to clearly specify at what price of equity share, what is the price at which the bond can be converted into equity share. This is going to be a predetermined price. They are going to tell today only that after 10 years, if you are going to convert your bond into equity share, we are going to convert it at a price of 150 rupees per share. So, depending upon what is your investment, 150 rupees is going to be applied, and equal whatever amount of number of shares will come, those many number of shares are going to be given to you. It is predetermined. That is conversion price. It is predetermined. It is determined at the time of the bond is issued, right? What is market price? Market price is the price that is prevalent on the stock exchange as on the date of maturity. If my debenture is maturing today, what is the price of equity share on the stock exchange as on today? That I am going to see, right? So now, for example, if I am going to get a conversion price of 100 rupees. For one equity share, I have to pay 100 rupees. The market price on the stock exchange is rupees 150. Now here, I don't have to pay 100 rupees. My principal amount of investment is in the form of bond. In lieu of that, they are going to give me equity share. But ultimately, what is the cost of one equity share for me? It is 100 rupees. Same equity share, if today I go and buy it from the market, I'll take redemption. I'll take all my value and keep it in my bank account. From the bank account, again, if I want to buy the equity shares of the same company, I have to pay 150 rupees per share. More expensive. Here, I'm getting at a discount of 50 rupees because the value is predetermined few years back. So what is beneficial for me in this case? Will I buy a product which is exactly same, absolutely same? It is just that the place of availability is different. Here directly the company is going to give me the shares by converting my bond into equity share. Here I am not buying it from the company, I am buying it from the secondary market, I am buying it from the stock exchange. They are giving me the price is 150. Same share is available for me because I am a bond holder at 100 rupees. What will I prefer? I will prefer going for conversion rather than market price. So in this case, I am going to apply for conversion and I am not going for redemption. Suppose the other way around, if this at the conversion price, they were giving me the share at 200 rupees per share, but the same share is available in the market at 180 rupees per share. In that case, I will take my all principal amount from the company, whatever principal amount is there, I will go and buy the share from the market. I will get at 180 rupees, 20 rupees per share I can save. That amount can still remain in my bank account for lesser price, same share. I am available getting it at the market price. So in this case, I am going to go for redemption and I will not apply for conversion. So you have to apply a basic concept of what is beneficial for the investor. You just have to compare two figures. You have to compare the conversion price with the market price and then determine what is beneficial for the investor. If somebody is going to give you a chocolate for 10 rupees and same chocolate is available at 5 rupees, from where are you going to buy? You're going to buy the same. It is commodity is same, brand is same, everything is same. It is exactly the same commodity. Just the price is different because the place of purchase is different. You will buy at the place where you're getting at 5 rupees. Why will you pay 5 rupees extra for the same commodity? The same concept applies here. You are going to compare two figures and see at what price the equity shares are available at which place. And then you are going to make the decision for the investor from whether he should go for conversion or whether he should go for redemption. So yes, for determining which option should be selected, that is conversion or redemption, the investor is required to compare conversion price with the market price as on the date of conversion. When we are going to apply for conversion, what is the conversion price, what is the market price? We have to compare these two values and then decide what is beneficial for us. Based on the comparison between conversion price and market price on maturity, whenever you are planning to do the conversion, if market price is more than the conversion price, what are we going to do? You're getting at a higher value in the market, but because you're a bondholder, you're going to get it as a lesser value. We are going to go for the conversion price. That means we are going to apply for conversion. Whatever value is less, we are going to select that. On the other hand, if the market price is less than the conversion price, we are going to select the market price, because same commodity we are going to get it as a lesser value. We are going to opt for redemption. Whenever we are going to go with the word market price, we are going for redemption. Whenever we are going to go with the conversion price, we are going to opt for conversion, right? If you are selecting conversion price, that means you want to convert. You are going for conversion. If you are not going with conversion price, if you are going with the market price, you want to purchase it from the market, you can purchase only after you are redeeming the value, getting the redemption value into your account and then purchasing it from the market. In that case, we are going to go for redemption. So two options are there, redemption and conversion. For reaching the conclusion, you have to compare the comparison price or the conversion price with the market price. If the conversion price is less, we are going to go for conversion. If the market price is less, we are going to go for redemption. This is the decision that you have to make. Let's take a quick example. Company A has issued bonds with the following terms and conditions. Issue price is 1000 rupees. Coupon rate is 2%. Maturity period is 2 years, which can be converted into equity shares at 800 rupees per share. Mr. I buys 4 bonds on maturity. If market price is 1250 rupees, what should be the decision for Mr. I? So always whenever you get any practical question, please first write down the given data so that again and again multiple times you don't have to read through the long question. So the issue price is 1000 rupees. He has bought how much? He has bought 4 bonds. So that means his capital invested becomes 4000 rupees. He has purchased 4 bonds of 1000 each. So he has made an investment of 4000 rupees. Next, we know that the interest rate that he is going to get is 2%. We know that the duration of investment is 2 years. And they've given us the conversion price and they've given us the market price. What is the conversion price? It can be converted into equity shares at 800 rupees per share. And on maturity, if the market price is 1250 rupees, what should be the decision of I? Should he go for conversion or should he go for redemption is what you have to say. Now draw a comparison. What is less? The conversion price is less than the market price. If you convert your bonds into the equity share, you will get 1 equity share for 800 rupees. But if the same share today you go and buy it from the stock exchange, you have to pay 1250 rupees for 1 share. What is beneficial for you? Conversion is beneficial for you. It is better that I goes for conversion because he is getting the same shares at a lesser value. We know we have to go for conversion, but that is not enough for the answer. You have to tell how much money he is saving or how many extra equity shares he'll get if he goes for 800 rupees conversion price, right? So let's see how we are going to answer this particular question. First, always write the given data. What is the conversion price? What is the market price? How many number of bonds he is purchased? What is the issue price? Out of this, we can get to know his total investment is 4000 rupees. Now let's see how are we going to draw the comparison. Mr. I has 2 options. Option A is conversion, option B is redemption. You should write these answers in the exam also. Now we should, if he goes for conversion, show the calculation. If he opts for conversion, he will be entitled to receive 1 equity share at 800 rupees. And how much investment he is made? 800 rupees per share. How much investment he is made? 4000 rupees. So how many equity shares will be entitled to get? He will be entitled to get 5 equity shares. He has 4000 rupees as bond value. if he converts his bond into equity share, he is going to get one share at 800 rupees. So if he has 4,000 rupees and one share is 800 rupees, he will be entitled to 5 bonds. 5 into 800 is 4,000. Right? So 4,000 divided by 800, he is going to get 5 equity shares. On the other hand, if he goes for redemption, that means he takes the entire amount of 4,000 rupees with him into his bank account and exits as a bondholder. After that, if he is going to purchase the company's share from the stock market, for one share he has to pay 1,250 rupees and the value is 4,000 rupees. How many shares will he get? He will get 3.2 shares, that is approximately 3 equity shares. So what is beneficial? In conversion, for same 4,000 rupees, you are getting 5 equity shares. If you are going for redemption, for the same 4,000 rupees, you are getting only 3 equity shares. So what is beneficial? At the same value, getting more shares is more beneficial. So yes, the Mr. I should opt for conversion and get 5 equity shares at the value of 800 rupees per share. That should be the conclusion to your answer. Give a conclusion that yes, I should opt for conversion of shares as he is entitled to more number of shares at the time of conversion for the same amount of investment of 4,000 rupees. Next, one more practical problem. Let's solve it. ABC Limited has issued bonds with the following terms and conditions. Issue price is 1,000, coupon rate is 3%, maturity duration is 5 years, convertible into equity shares at 500 rupees per share. Mr. P has purchased 20 bonds. At the time of maturity, the market price of equity share was 400 rupees. What are the options available for P on maturity date and what should he prefer? So theory question also they have attached. What are the options available for P? So first you should tell that he has 2 options available for him. First option is conversion, second option is redemption. These are the 2 options. In conversion, his bond can be converted into equity share. In redemption, the principal amount will be given to him by the way of cash into his bank account. These are the 2 options available with him. Now let's write the given data and see what is beneficial. What is the given data? Given data is he has a price of one bond is 1,000 and we know the number of bond he is purchased is 20. So what is his total investment that he's made in bonds? It is 20,000 rupees. That is principal amount of investment. The coupon rate is 3%, not significant, not relevant for us. Maturity period is not relevant for us because they have directly given us the value. They have not given us different dates and market price. If they give different dates and market price, then the period of investment becomes necessary. We have to calculate on which date it is going to mature. But since they have directly given the data, the coupon rate and the maturity data are irrelevant for us. It can be converted into equity shares. So the conversion price they have given is 500 and they have said at the time of maturity, the market price of the share was 400 rupees. So by seeing this, we know market price is less than the conversion price. So by applying the general logic, we can directly say that it is better if Mr. P selects the market price and goes for redemption. Because he is selecting market price, he is going to go for redemption. If he selects the conversion price, he is going to go for conversion. But here market price is less than the conversion price. So we are going to select redemption. Redemption is better for P. But you have to prove it. Why redemption is better for Mr. P? How many number of extra shares he can get if he purchases it from the stock exchange and not go for conversion. So we know that his principal amount of investment is 20,000. If he is getting 20,000 cash and he is paying 400 rupees for one share, how many shares will he get? On the other hand, 20,000 is his investment. If he applies for conversion at 500 rupees, how many shares he is going to get? You have to give that correct data. So this is the given data. Give that he has 2 options theoretically. Draw the comparison. Option A, if he goes for conversion price is 500 rupees. His actual investment is 20,000 rupees. So by applying the logic, the number of shares that he can get is 40 equity shares. On the other hand, if he goes for redemption, the actual investment again is same 20,000 rupees he is going to get by the way of cash in his account. The market price that is prevalent is 400 rupees. So actual number of equity shares that he will be entitled to receive is 50 equity shares. So it is better to purchase from the stock exchange. It is better to go for redemption because you're going to get 50 equity shares. Here you're going to get 40 equity shares. 10 extra shares you can get if you purchase directly from the stock exchange rather than converting your bond into equity shares. So it is better you redeem your value and then purchase it from the stock market, because you're going to get 10 extra shares. So that is the final answer you have to give in the conclusion, that P should choose option B and go for redemption of bonds, as he is going to entitle to more number of shares at the same value of investment of 20,000. Here also investment is 20,000, here also 20,000. Here because the price is 500, he is only going to get 40 shares. Here because the price is 400, he is going to get 50 shares. So that is the comparison, that is the answer that you have to do. Compare the comparison price with the market price. Whichever is lower, we are going to go for that value, and we are going to come with the outcome. Whether if he selects conversion price, he is going to go for conversion. If he selects the market price, he is going to go for redemption. But ultimately you should show the number of shares. What is the number of shares difference that is coming in both the methods, and then give a valid conclusion. The next instrument is foreign currency convertible bond. Let's identify the concept with the terminology and then get into the theoretical concept. FCCB, foreign currency convertible bonds. By the name itself, what we can identify, what is foreign? Something that is outside the country. What is currency? Money that has various denominations. The currency in India is what? Indian rupees, INR. What is the currency of United States? It is dollars. What is the currency of UK? It is pounds. What is the currency of Japan? It is Japanese yen. So different countries have different currencies that are in operation, and that is what we call as currency. Convertible is nothing but any instrument that can be converted from one form to another. Here we are talking about bonds. So the bonds can be ultimately converted into equity shares. So please note one thing, that whenever any convertible portion is attached to any financial instrument, the final outcome must necessarily and mandatorily be equity shares. For example, we started with preference shares, convertible preference shares. Preference shares are converting into preference to equity shares. Convertible debentures, debentures are converted from debentures to equity shares. Convertible bonds, bonds are converted from bonds to equity shares. The final outcome has to necessarily be equity shares whenever the convertible portion is attached to a financial instrument. And bond is nothing but a debt instrument which is going to earn returns by the way of interest. So what is foreign currency convertible bond? It is a bond which has the convertible portion attached to it, but this bond is issued in a foreign currency. That means it is definitely not done in Indian rupees. It is done in any foreign currency. Next question is, if we are going to issue the bonds in foreign currency, how will the Indian investors have those foreign currencies for the purpose of making that investment amount? So the question directly gives you the answer as well, that these kind of bonds are not issued to the Indian investors, because we Indian investors do not have foreign currency. We are issuing these bonds with the objective of raising capital from a foreign market, from an international market, and we are going to denote these bonds in foreign currency because the people or the investors of a foreign country are going to have the currency of their respective country and not Indian rupees. That is why whenever we are going to plan to raise money from the international market, we are going to issue the instrument also in a foreign currency itself. So what is a foreign currency convertible bond? It is a bond which is issued by the Indian company with the objective of raising capital from a foreign country, which is going to have a convertible element attached to it as a characteristic, and is it issued in the foreign currency because the investors have the currency of their own country. That is why we are going to denote it and issue it in a foreign currency itself. With this basics, let's understand the concept. So we have a company which is situated in India. Let's call this as Indian issuing company. So this Indian company gets an idea that let's raise money from the international market. Let's raise money from the international market by making an issue of foreign currency convertible bonds. Okay, let's use this instrument for the purpose of raising capital. So now their target is raising money from foreign investors who are belonging to some other country. And they have decided that they're going to issue bonds. So the investors are going to have dollars in hand. You can't ask them to give the company Indian rupees. So what are we going to do? We are going to give them the bonds. They are going to give us the principal investment, the capital, the bond value investment in dollars itself. The investors are going to invest dollars for the purpose of purchasing the bonds from the Indian issuing company. And when they have given us the principal amount, we are bound to give them the interest as return on their investment on periodic basis. And when we are paying that interest should also be paid in dollars itself, because if we give them Indian rupees, what are they going to do with the Indian rupees? What will they do? First, Indian rupees weaker than US dollars. Why will they accept it? Second, even if we give them the Indian rupees, where will they use it, right? So for these 2 or 3 reasons, we have to give them the payment even in dollars itself. So we are receiving the principal amount in dollars. We are going to give them the return back in dollars itself. It works similar to that of bonds, just there is one difference, that there are 2 different countries that are going to be involved. The issuing company will be from India, and the investors who are going to purchase these bonds are going to be foreign investors. That is the only difference. Next question comes, what is going to happen at the time of maturity? Similar to what happens in bonds, they are going to have 2 options. One is either redemption or conversion. If they are going to convert, they are going to get equity shares of same Indian issuing company itself. How regular bonds function, similarly this is also going to function. So on maturity, the option will be given to the bond holder, that is the foreign investors, to convert their bonds into equity shares of the same Indian issuing company itself. So this is the entire concept of foreign currency convertible bonds. Let's look at the theory. It is a bond, so all the characteristics, all the elements of a bond will apply to foreign currency convertible bond as well. It is issued by Indian company which has an objective of raising capital from a foreign market. Most important thing, that it is going to be expressed in foreign currency. The principal amount is going to be received in dollars or in foreign currency. The interest also has to be paid in the foreign currency, and it has to carry a fixed rate of interest. We all know that bonds are debt instruments on which the return has to be paid by the way of interest on periodic basis. So that interest is also going to be predetermined. Prior only we are going to tell what is the interest that we are going to give on the principal investment that you are going to make by purchasing these bonds. Next, the foreign currency convertible bonds are unsecured instruments which are going to carry the option to be converted into fixed number of equity shares at a fixed price. That means similar to bond, here also the conversion price is going to be predetermined. They are going to tell at the time of maturity, if we are going to convert your bond into equity share, this conversion price is going to become applicable. So you know what is the investment that you have made. You know what is your principal amount that you have given to them as capital. On that, you know what is the conversion price at maturity period. So you can actually figure how many number of equity shares you will be entitled to receive when maturity takes place at conversion price. Right, same concept what we have studied for bond, same has to be applied even here. The options available at maturity are same: conversion into equity share or redemption of foreign currency convertible bonds. If the bonds are converted, the equity shares of the same bond issuing company itself is going to be issued to the bond holder. That is all about foreign currency convertible bonds. Let's move to the next instrument, that is foreign currency exchangeable bonds. Same concept what you have studied in foreign currency convertible bonds is going to be applicable here, with only one difference between the two. We will identify what is the difference. Okay, so what was the scenario there? We have an Indian company. That Indian company is planning to raise capital from the international market. So it is a company, Indian company. We will call it as the Indian issuing company. Indian issuing company. This Indian issuing company is getting an idea, let's raise capital from the foreign market. So they have decided that we are going to issue something called as foreign currency exchangeable bonds. So they make an issue of foreign currency exchangeable bond. They are going to issue the bonds. The Indian issuing company which got this idea, they are going to issue these bonds with the objective of raising capital from foreign investors who are situated in some other country. They have foreign currency in their hands. So again, these instruments, foreign currency exchangeable bonds, are also denominated in a foreign currency. So we are going to receive the payment of a principal in foreign currency. We are going to pay back the interest also in foreign currency. So both the principal and interest are payable in foreign currency itself. Till here it is exactly the same with respect to what happened in foreign currency convertible bond. Now one word is different here. That word is exchangeable. Instead of convertible, we call it exchangeable. What is exchange? Giving something and taking something else. That is exchange, right? Take a pencil and give me a pen. That is exchange. We are exchanging things amongst ourselves. So here what are we exchanging? We are exchanging the bond for equity shares. That is convertible. But here we are not talking about one company, but here we are talking about two companies. What are we telling? We are exchanging the bond of one company with equity share of another company. What happened in foreign currency convertible bond? The bond issuing company itself on maturity gave its own equity shares to the bond holders. But here we are not converting the bond into equity share only. We are converting the bond into equity share, but not the equity share of the Indian issuing company, but equity share of some other company. We are exchanging the bond for equity share of some other Indian company. That is why we call it as exchangeable. We are converting the bond into equity share, that is there. But in addition to that, we are changing the company only. No, we are exchanging the bonds of one company for equity shares of some other company. There is an exchange that is taking place. So that is why we call it as foreign currency exchangeable bonds. So till the time of getting the principal and paying back the interest, it is the same thing. Now what changes is at the time of maturity. At the time of maturity, a second Indian company will come into existence. First one is the Indian issuing company which has issued the bond. It is called as the bond issuing company. And you have one more company in picture which is called as the Indian offerer company. This second Indian company is going to give its equity shares to the bond holders. So on maturity, what is going to happen? We are going to give an option to the bond holder to exchange their bonds for equity shares of the Indian offerer company. In foreign currency convertible bond, this Indian issuing company itself was the Indian issuing bond company, and this company itself gave its own equity shares to the foreign investors. But in foreign currency exchangeable bonds, we have two Indian companies which are going to be in picture. One is the Indian issuing company which is going to issue bonds, and you have one more Indian offerer company which is going to offer its equity shares. Right? So that is why we are exchanging the bonds of the Indian issuing company for the equity shares of the Indian offerer company, and that is why the terminology exchangeable has been used. So what is the difference? The difference between foreign currency convertible bond and a foreign currency exchangeable bond is that here there is only one company in existence which is called as the Indian issuing company. Here we have two companies which are going to be involved, and both the companies are Indian companies. One is going to be called as the Indian issuing company which is going to issue the bonds, and one more is going to be called as the Indian offerer company because it is going to offer the equity shares to the foreign investors. Right? Here, the Indian company itself is going to give its own equity shares. Here, the offeror company is going to give its equity shares and the Indian issuing company will not give its shares. This is the predominant difference between foreign currency convertible bonds and foreign currency exchangeable bonds. So let's have a quick look at the theory. Foreign currency exchangeable bond is used to raise funds from the international market, exactly the same. It is issued by Indian company called as the issuing company. That is the first company that is going to be involved. A bond expressed in foreign currency with principal and interest payable in a foreign currency, similar to that was the case in FCCBs, that principal and interest both have to be paid in dollars and the bond also is going to be denominated in foreign currency because we are raising money from international market and foreign investors are going to have the currency of their own country. And subscribed by person resident outside India. Obviously, you are raising money from international market, that means the investors are also not going to belong to our own country. Next, the most important thing and the distinguishing feature is this, that on conversion, you can exchangeable equity shares of another Indian company called as the offeror company. We are going to exchange. What are we going to exchange here? We are going to exchange the bond of Indian issuing company for what? We are going to give that and we are going to get the equity shares of another Indian company which is going to be called as the offeror company. This Indian company is offering the equity shares of its company to the bondholders of another Indian company, right? So that we are exchanging the bonds for equity shares of some other company. Next, the issuing company and offeror company both should belong to the same promoter group. Very, very important. The conditions that have to be satisfied for making an issue of foreign currency exchangeable bonds. You might ask, when one company has issued the bonds, why would some other company give its own equity shares to these bondholders? Because both these companies belong to the same promoter group. Both the companies belong to the same promoter group and that is an essential requirement. Offeror company should be listed and be eligible to receive that foreign investment. So the offeror company, this company which is going to give its equity shares in exchange for the bonds, this company should be listed on the stock exchange in India. Because it is raising money from international market, it should be listed. In addition to that, one more condition is there. It should be eligible to raise foreign capital. Because there are certain restrictions when foreign capital is going to be raised. You need permission from the Reserve Bank of India as well because foreign currency is going to be involved. So you not only have to be listed on the stock exchange, but you should also be eligible to receive foreign investments. To raise money from foreign market, you should need the permission. And please note that foreign currency exchangeable bonds are converted into shares of offeror company that forms a part of the same promoter group as that of the issuer company. So the Indian issuing company and the Indian offeror company, both these companies that are involved in the transaction, both these companies should belong to the same promoter group. And with respect to the offeror company which is going to ultimately give its equity shares, that company should be listed on the stock exchange, plus it should also be eligible to raise foreign investments. If these conditions are satisfied, only then foreign currency exchangeable bonds can be issued by the Indian companies. Next. So that is about foreign currency convertible bond and foreign currency exchangeable bond. The difference is important. Let's move to the next instrument, that is Indian depository receipts. It's exactly opposite of what happens in foreign currency convertible bond. So what is this? You have a foreign company and that foreign company gets an idea that can we not raise money from Indian markets? So they are going to target Indian investors. They are going to target Indian investors. So IDR is issued by a foreign company. Foreign currency convertible bond and foreign currency exchangeable bonds, both are issued by Indian companies. But this Indian depository receipt is issued by a foreign company with the intention of raising money from the Indian investors, from the Indian market. And now, if their target is Indian investors are going to have rupees. They are not going to have any other currency in pocket. So IDR is always going to be denoted in Indian rupees because they are targeting India as its market. So what is going to happen? This foreign company is going to get an idea that let's raise money from the Indian market by issuing Indian depository receipt. So what is the procedure that they have to follow? They are going to issue shares of their own company. They are going to issue the shares of their own company and keep those shares with the custodian which is situated in the country of that foreign company itself. Let's say United States. This custodian will also belong to the United States. So the company has issued shares to this custodian. Why can they directly not give shares to the Indian investors? Because there are a lot of restrictions for the issue of shares. With respect to demat accounts, with respect to permissions, there are n number of complications where direct investments in the shares cannot be done. So, that reason, they are going to issue shares of their own company and those shares are going to be given to the custodian. Custodian is going to keep their shares. Now, that custodian which is situated in the foreign country, they are going to give an authorization to the domestic depository, that is the depository which is situated in India. What is the role of depository? To provide demat services, right? So, what are they going to do? They are going to give an acknowledgement receipt in the form of the Indian depository receipt. What is Indian depository receipt? Is an instrument that the Indian investors have made an investment in the foreign market. Because they cannot directly get the shares, they are getting an instrument whose value is determined on the basis of the price of these equity shares. So, we call the Indian depository receipt as a derivative. As a derivative, the IDR itself has no value. The value of IDR is going to be determined on the basis of what is the price of the shares of the foreign company. If the share price of this particular foreign company's share increases, the value of IDR is also going to increase. If the share price of this foreign company falls down, the value of that Indian depository receipt also falls down. So, it is only a receipt. It is only a receipt. It is only an acknowledgement that Indian investors have made an investment in the foreign market. The value of that receipt is based on the value of the foreign company's share. Right? So, because we cannot directly give them the shares, we are only giving them an acknowledgement receipt that you have made an investment in the capital of this particular company. Because we cannot give you the shares, we have created this mechanism that the company is going to issue the shares. Those shares are going to be retained by the custodian on behalf of the Indian investors. In lieu of that, you have to give some acknowledgement to them that you have made the payment. So, we are going to authorize the domestic depository which is situated in India to issue a depository receipt, that is Indian depository receipt, for the payment that they have made in this particular company. And the value of that IDR itself, it has no value. If the share price of foreign company goes up, the value of IDR is going to go up. If the share price of the company comes down, the value of IDR is also going to come down. So, in simple terms, Indian depository receipt is a derivative which is going to derive its value from an underlying asset, which is the shares of this foreign company. So, this is the concept of Indian depository receipt. So, let's see certain concepts. We have the definition for Indian depository receipt. Indian depository receipt has been defined under section 2 subsection 48 of the Companies Act 2013, which says that any instrument in the form of a depository receipt which is created by a domestic depository in India and which is authorized by a company incorporated outside India making an issue of such depository receipt. So, here we have multiple parties here. You have a foreign company. This is the company which is planning to raise capital from India. Second, you have Indian investors who are going to actually make that particular investment in that particular company. Then you have a custodian, and this custodian we call it as overseas custodian, because this custodian is situated in the country where the foreign company is situated. And lastly, we have the domestic depository, which is going to be situated in India. So this foreign company is going to issue shares. Indian investors are going to give Indian rupees. These shares are going to be kept under the custody of the custodian. Because custodian are holding the shares on behalf of the investors, they are going to authorize the domestic depository that please issue a receipt of acknowledgement to the Indian investors that they have made an investment in this particular company. So it is just a receipt, it is just an acknowledgement that an Indian investor has made an investment in the foreign market, and the value of that receipt is based on the value of the underlying asset being the shares of this foreign company. Yes. Let's look at the explanation. It is issued by a foreign company with the objective of raising capital from the Indian market. That means their target are Indian investors. Depository receipt is denominated in Indian currency because we as Indian investors are their target, and we as Indian investors are going to have only Indian rupees. So we are going to make an investment in Indian rupees. So it is going to be denominated in Indian rupees. Its underlying asset is equity shares of the foreign company. Like I told you, it is a derivative. It itself does not have any value. The value of IDR is going to be based on the value of the company's shares. If the share price of that foreign company goes up, value of IDR goes up. If the value of that foreign share of the foreign company falls down, the value of IDR is also going to fall down. So the underlying asset, the asset on the basis of which the IDR derives its value, is equity shares of that foreign company. The actual shares underlying the IDRs would be held by an overseas custodian, which is going to authorize the Indian depository to issue the IDR. So I have told you the chain. There is a foreign company issues the shares. These shares are going to be kept with the custodian. The custodian is going to hold it on their behalf, but it is going to give an authorization. It is going to give an authorization to whom? To the domestic depository situated in India, that please further make an issue to the Indian investor. The value of this is going to be determined on this. This is the share that is going to be issued. This is the IDR that is going to be issued. The value of the IDR is going to be based on the value of the share of a foreign company. So this is the link that is created. So the foreign company authorizes the custodian to keep the shares on their behalf. Custodian further authorizes the domestic depository that you please further make an issue of IDR to the Indian investors. IDRs are derivative instruments because they derive their value from an underlying asset, and that underlying asset is the shares of this particular foreign company. Foreign company issuing IDRs have to comply with the requirement and rules of both Companies Act, SEBI regulations and RBI notifications and circulars. So here, what is the objective of SEBI? To protect the interest of investors. Okay, not only in the Indian market, but if Indian investors are putting their money in the foreign market, even then the Indian investors should be protected. So any foreign company which is planning to raise capital from the Indian market are subject to Indian rules and regulations. If they want to issue IDR, they have to follow the provisions of Companies Act 2013. They have to comply with all the SEBI provisions. They have to comply with all the RBI notifications, because two countries are going to be involved, right? There is going to be forex. So in that case, even RBI is going to come as a regulatory authority. So that foreign company which is planning to raise money from the Indian market has to ensure compliance with all these provisions of law. Next instrument is a derivative. We already have some knowledge of derivative because IDR is one form of derivative. What is it? IDR is an instrument. It is a receipt which derives its value from an underlying asset, and that underlying asset is the equity share of the foreign company. This is what we have identified. The same concept is derivative, where any instrument derives its value from any other underlying asset. We call it as a derivative. Let's have a look. Derivative is a financial instrument that derives its value from some other underlying asset. If the underlying asset is gold As the price of gold goes up, the value of that receipt also goes up. If the value of gold falls down, the value of that financial instrument is also going to fall down. It could be any other thing, it could be any other commodity, it could be shares, it could be commodities, anything. Okay. So the underlying asset can be stock, bond, currency, commodity, metal, and even intangible assets like stock indices. So what? The underlying asset can be shares, it can be currency, it can be bonds, it can be metals, it can be gold, I mean to say. So these are all the underlying assets that are there in the derivative segment. Now, they have defined the term derivative. Securities Contract Regulation Act 1956 derives the term derivative. It says that it includes, so again there is no definition, they have only given what is included as a derivative. It includes a security which has derived from a debt instrument, from a share, from a loan, whether it is secured or unsecured, risk instrument or contract, for differences or any other form of security. So where it is deriving its instrument from some other value, then it is going to be called as a derivative. Or a contract which derives its value from the price, index of a price or underlying securities, a commodity derivative, or any other instrument as may be declared by the central government as a derivative. So not an important definition, and it does not convey correctly what is it also. Only we can identify that the derivatives can be on the basis of shares, on the basis of debt instruments, on the basis of loan, on the basis of contracts, on the basis of commodity derivatives, and the miscellaneous provision is the central government at any point in time can include any other instrument under the ambit of term derivative. But what is more important for us to understand is the meaning of it, that there is one instrument, the value of this instrument is based on the value of some other asset. And that asset can be anything. It could be gold, it could be shares, it could be currencies, anything. So as the value of these assets go up, the value of this particular instrument is also going to go up. If the value of these assets fall down, the value of this particular instrument is also going to fall down. So as such, the derivative instrument has no value. It's going to derive its value from the value of one more asset, which could be of various categories, right? That is derivative. The derivatives can be of different types like futures, options, swap, cap, floor, collars, etc. In India, we have predominantly futures and options, which we are going to cover in depth in chapter number 2, that is the secondary market with numerical problems. So very, very important aspects is futures and options. The most popular derivative instruments are futures and options. Even in India, the most operating ones are futures and options itself, and that is why we are also going to cover the numerical concepts, numerical problems and practical problems from this particular concept, but not here, but in chapter number 2. Next, various kinds of derivative on the basis of underlying asset. What is the underlying asset? It is as currency derivative. It could be a currency of a foreign country, commodities, and securities. Okay. And on the basis of characteristics of nature, it can be forward, future, and options. More of this we are going to study in lesson number 2. Next instrument is warrant. This is not a search warrant. It is not a warrant of arrest also. What is warrant? Here we are giving you a specific right. What are we giving? Warrant is also one instrument. It is an instrument. If you are purchasing this instrument, what are you getting? You are getting a right. You are buying a right. By purchasing a warrant, you are buying a right. But right to what? Right to buy equity share on a future date at a particular price. So here we are not purchasing any instrument as such. By purchasing the warrant, we are purchasing one more additional right, that you can convert your warrant into equity share. You can purchase the equity shares at a future date. So let us see what it means. Warrant is an option. We are giving an option, we are giving a right, we are giving a choice to the company, issued by a company, whereby the buyer is granted the right to purchase a certain number of equity shares at a pre-given exercise price during a given period. What are we giving? We are giving an instrument called as warrant. If you are purchasing a warrant, the company which is issuing warrant, it is giving an option to the holder of the warrant that at any given point you will have a right to purchase the equity shares of the company. See here, there is no obligation. We are not putting it as mandatory, you have to buy the equity shares of the company. If you have warrant, you can buy. If you want, you can buy the equity shares at a predetermined fixed price. The warrant holder has the right but not the obligation to convert these warrants into equity shares. So now, like the concept of bond, in the bond we had two options, conversion or redemption. In warrant, what we have? If you are a warrant holder, you have a right. It is your choice. It is your option to decide what you want to do. What are the two options available with you? You have two options. One is let the warrant lapse or convert the warrant into equity shares. That is nothing but purchase the equity shares. What are the two options with the warrant holder? Let the warrant lapse, or you convert your warrant, you use your right, you make that choice and buy the equity shares at the price that has been predetermined. Again, this is the total choice of the warrant holder. It is not an obligation that mandatorily he has to convert his warrant into equity shares. It is absolutely his choice. If he is not happy with the pricing of the equity share that has been quoted, price of equity share, if he is not happy with the price that is being offered to the warrant holder, he can let it lapse. He might not exercise it. Okay, he might say, let the warrant go for a waste. I'm not going to buy equity shares from them because the pricing is not appropriate. Like we converted compared the conversion price and the market price in the case of bonds, similarly here also we have to draw a comparison and then identify whether we should let the warrant lapse or we should actually buy the shares by using that particular warrant. Okay, so what is a warrant? Warrant is a receipt or it is a right that we are purchasing. We are purchasing an option to buy equity shares of the company at a future date at a predetermined price, right? And it is the choice and it is the right of the warrant holder whether he wants to convert his warrant into equity shares or whether he wants the warrant to lapse and not use the warrant. Let's see. Meaning, a warrant signifies optional conversion. It is left to the choice of the warrant holder. Options available with the warrant holder. He has two options: converting his warrant into equity shares or letting the warrant lapse. Lapse means we are not going to use the right. We are not purchasing the equity shares. So he decided on the basis of comparison between exercise price and market price. In bond we had comparison price, we had conversion price, right? We had the conversion price that was available. We compared that conversion price with the market price. Here it is the same thing but different terminology is going to be used. Exercise price is what we are going to call it as. Exercise price, because here the warrant holder is exercising his right to convert the warrant into equity shares. That is why term exercise has been used. It is similar to that of the conversion price, but here the denomination or the terminology we are using is exercise price. So we are going to compare the predetermined exercise price with the market price and then decide should we purchase it from the market or should we use the warrant to purchase the equity shares. For example, conversion price of the warrant is rupees 70. Current market price is 110, right? If you are going to use the warrant, you are going to get the equity share at 70 rupees. If you are going to purchase the same shares from the market, you have to pay 110 rupees for it. And what is beneficial for you? Something that is for lower value, same commodity, you are getting at different places at different price. So you are going to buy the same commodity at a price that is available at a lesser cost. So here the investor will definitely convert the warrant, because the warrant price, that is the exercise price, is 70 rupees. So he can enjoy the capital gain of 40 rupees, that is 110 minus 70. If he would have bought from the market, he would have bought at 110 rupees. But here, because he has a warrant, he is converting his warrant into equity share, he is going to get his share at 70 rupees. The difference between is the profit or the gain that he is making by using of that particular warrant. So he is saving 40 rupees by purchasing the equity shares, by converting his warrant into equity share rather than letting his warrant lapse. Next. Conversion price is 70, market price is 40. The investor will simply let the warrant lapse without conversion. What are they telling here? They are telling the conversion price or the exercise that we call is 70, and the market price, when he has to actually make that decision, the market price is 40. When same commodity is available in the market at 40 rupees, why will you use the right to buy the same share at an expensive price? You will not make use of the warrant. You are going to let the warrant lapse. So here we are not going to tell, we are going to redeem, because you have not made any principal investment as such. You have just paid a little amount to purchase that warrant. So there is no redemption. Here we are talking about letting the warrant lapse. So that is the difference. In bond we have two options, conversion and redemption. Here we have two options, conversion and lapsing of the warrant. If you are selecting the conversion price or exercise price, that means we are going to make use of the warrant. In case you are selecting the market price, we are going to say that we are going to let the warrant lapse. So here he can purchase the same shares from the market at 40 instead of paying at 70 for the purpose of conversion. So the conclusion is we are going to let the warrant lapse. So we are going to draw a comparison between exercise price and the market price and then make a decision. If we are going to select the exercise price, that means we are making use of the warrant, and in case we are going to select the market price, that means we are letting the warrant lapse. Please remember, there is no redemption in warrant. The price that you have paid to purchase the warrant, that price you are not going to get it back. You have just purchased a right to make a decision on a future date to purchase the equity shares at a predetermined price. That's it. You have not made the principal investment as of now. You have only paid certain sum of money to buy that warrant, to buy that right to make a decision on a future date. So the price that you have paid for the warrant, that is gone. Once you have purchased the warrant, that money is gone out of your pocket. Next only comes is how you can save money. Whether you can get equity shares at a lesser price by exercise price, or you're going to get shares from the market price. That is what you have to determine in case of warrant. Before going, let's quickly sum it up. Whenever you get practical problem on bonds, you are going to have two options. One is conversion and one is redemption. In redemption, what is going to happen? You are going to get back your principal investment that you have made. The principal investment is going to come back to your bank account. If you're going for conversion, you're going to convert the bond into equity share. That means you're not going to get back your principal amount, but you're going to get equity shares for equal value of principal investment. In both these cases, the interest is periodically paid, so no question on getting back the interest back. You're only going to get the principal investment at the time of maturity. When you talk about warrant, in warrant, you have two options. One is let the warrant lapse and another one is you exercise the warrant. When you exercise the warrant, you are buying equity shares. When you're letting the warrant lapse, you're not using or you're not buying the equity shares. Here you're going to draw a comparison with exercise price and market price. Here we're going to draw a comparison between the conversion price and market price. Whichever is low, we should select that. If you're going to select conversion price, we are going for conversion. If you select for market price, we are going to go for redemption. Here if you select exercise price, you are going for exercising the warrant. If you're going to select market price, that means you're going to go to lapse of warrant, right? This is the basis. Let's go to the next instrument, that is REITs, which is called as the Real Estate Investment Trust. What is Real Estate Investment Trust? Real estate is nothing but property. Buildings, land, site, all this comes under real estate. Investment trust. Investment is you're putting money in real estate, and trust. Trust is a form of business organization. You know, different forms of organization, trust is there. So when you're creating a trust for the purpose of raising investment, specifically to be made in the real estate sector, it is called as the Real Estate Investment Trust. What? It is a trust that has been created for the purpose of making an investment in the real estate sector. That is Real Estate Investment Trust, to be simple. Now, why do we have? Directly you can purchase no property, land, building, you can directly purchase. Then why is there a need for having a real estate investment trust, and how can this be an instrument? Now, if I want to go and buy a house, if I want to go and buy a property, I have to take care of so many things. What is the situation of the property? Where is it located? What is the accessibility? Whether good roads are there? Whether there is a community, whether hospitals are nearby, whether schools are nearby? What is the facility that is available in and around that particular location? What is the future prospects of that particular area where I am going to buy a property? N number of factors are there that we have to take into consideration before buying any property. Whether the title deeds of that particular property are genuine or not genuine. Where do we find the seller? What is the background of the seller? N number of things we should take in consideration when we are going to buy a property for ourselves. And at times, the real estate nowadays is so expensive. Plus, after the income tax amendment, the budget that has come, what are we going to do? So expensive. Everything is expensive. As a person, if I want to buy a real estate in crores of rupees, where will I get the money? Maybe I will never be able to buy a property for myself. In that case, people who are in this scenario, how are they going to take the benefit of the boom in the real estate? How can they take benefit of returns from the real estate sector? What they can do is, multiple investors can come together and buy one building. What happens generally? What is the general scenario? This person is there, he is working really hard so many years, and then he is going to collect a pool of money, and later he is going to buy a property for himself. This takes so many years, and so many complications are associated of finding the property, finding the seller, finding the genuineness of the property, the genuineness of the documents, and n number of other practical problems. On the other hand, if you are facing these problems, what you can do is, a lot of investors who have little money in their pocket, all of them can contribute money to one fund. This fund can further be used to purchase this property. Whatever income you get from this property, whether that is rental income, capital appreciation, whatever, that return will be shared among them. So whatever value or income you can have out of real estate, you can do it with collective group of investors. That itself is the Real Estate Investment Trust. What happens here? What happens here is, you have a lot of investors. Let's assume that these investors do not want a property for themselves, as in they don't want to reside. They have a house, everything is set. They only want to make investment. Or there are few investors who can never buy property for themselves because of so expensive values of real estate, that they want to take benefit of the real estate boom. They want to be a part of the profits in the real estate, but they cannot buy one entire property for themselves. What are they going to do? They are going to give all the investment that they have, or the money that they have, to this particular trust that has been created. They are going to give money and buy shares of REIT. We call it as units. So because we are giving the cash to them, they are going to give us a unit of their trust. Like we give money in the share capital and get equity share, here we are giving money and buying units of REIT. So now this REIT has a lot of pool of money. It has an entire pool of fund which is going to be given by lakhs and crores of investors. We have collected a pool of money. Using this pool of money, we are going to buy a real estate property. And specifically, we have to buy income generating properties. We are going to buy commercial buildings. We are going to make an investment in income generating properties. What is happening? Multiple investors are there. They want to make use of the income in the real estate sector, the boom in the real estate sector. So they are going to give whatever little cash they have, whether it is 1,000, 5,000, 10,000, 15,000, 20,000. They don't need crores of money to make an investment in the real estate sector. How much ever money they have, they are going to give it to the trust. Like this, a lot of investors are there, so a pool of money is going to be created. That pool of money can further be invested in the real estate sector, because this REIT, the trust, is going to purchase income generating profits. Once you're making an investment in the income generating properties on a monthly basis, you are going to get income. It could be rental income, right? So that income is going to further be shared with the investors for the cash that they had given, because from their money we have bought this property. So whatever income we are generating, we have to give it to them in the form of returns. So all that we earn in the way of capital appreciation and rental income. Capital appreciation is increase in the value of the property. We have already discussed the term capital appreciation. So value of the property is also going to go up. You're going to have, so that will also going to reflect in your rental income. So you're going to get rental income, or you're going to get capital appreciation. These returns have to be shared with the unit holders in the form of dividend and price appreciation. Dividend is nothing but your rental income, and once the capital appreciation takes place of the property, if your REIT is performing well, that means the units of the REIT are also performing well. Like if the company is performing well and there is a demand supply mechanism, the share price of the company is going to go up. Similarly, if the REIT is performing well, the unit is also going to increase its value. Similar to how shares function, units of REIT is also going to function. There is going to be price appreciation in the unit value of a REIT as well. Plus, when the REIT sells one property, the property is sold at capital appreciation. That is also an income for them. So whatever income is going to be generated by that income generating property, that has to be passed over to the ultimate investors. Like this, the investors, even without buying an entire property, a small part in a entire big property, they are able to generate income from the real estate sector. It is not necessary that you should be the owner of the entire property. You are the owner of a part of that property. One big building is there, only one room in that building you might own, because of the capital that you have contributed. So you need not have crores of rupees for the purpose of making or taking leverage of the real estate sector boom. You can also do it by purchasing units of the REITs, where by the virtue of that contribution, you are contributing into the real estate sector. So what is a real estate investment trust? It is a trust which has been created for the purpose of making an investment exclusively only in the real estate sector, and thereby sharing the profits with the people who have given you the capital for making an investment in that income generating property. Okay. So REIT is a collective investment scheme. Why do we call it as a collective investment scheme? Because a lot of investors are coming together and a pool of fund is created. Collective investment. A lot of people are coming together, and because they are coming together, we are able to collect the capital. We are going to collect the investment, and the pool of fund is going to be created. A collective investment is going to be done, and the scheme through which this collective investment is done is a REIT. So REIT is a scheme through which we are making a collective investment. We are collecting a lot of money from a lot of investors for the purpose of making an investment in real estate sector. So a REIT is a collective investment scheme that owns, operates or finances income producing real estate, and the most important thing is they should make an investment only in income producing properties. They should make an investment in commercial properties. They should not make income in dead properties where the avenue for generating income is zero. Those kind of properties we will not make an investment in. REITs provides all investors the chance to own valuable real estate. You need not put crores of money to buy one property. Just by giving a few thousand rupees to the REIT, you can be a part owner of a property. You will not be the 100% owner. You will be a part owner, fractional owner of that particular real estate. REITs provide investment opportunities to those investors who do not have large sums of money to buy land, building, etc. Like I told, to buy an actual property, land, house, property, you need crores of rupees these days, even in tier 2 cities. So in that case, all of us will not be in a capacity, a lot of people will not be in a capacity to buy real estate. So those kind of people can make use of the real estate sector by making an investment in these REITs and generate income of those properties. Let's see what are the benefits of making an investment through the REIT. First one, less capital intensive. Like I told you, do not have to have crores of rupees for making an investment in the real estate. How much available funds you have, you give that much to the collective investment scheme. They will collect that money from crores of investors. So automatically they will get crores of rupees. That money they are going to buy the real estate property or the income generating property. So it is not capital intensive. How much ever you have, you give it to them. Okay. Investment in real estate is really expensive, but shares of REIT are very affordable. So if you want to make an investment in REIT, it is very affordable. You do not have to have crores, a few thousands is sufficient. Suitable for small investors because it eliminates dealing with big builders. Next. Transparency is there because like the shares are listed on the recognized stock exchange, even the units of REIT are listed on the stock exchange. So all the information is available in the public domain. Transparency is there. There is no scope for any kind of fraud or wrongful activity. Next, assured dividends. REIT generate income from rents. I told you, whenever the REIT is going to purchase the real estate, they have to buy the property, income generating properties, and that is why you are going to get rent, and that rent is going to be shared as dividend with the investors of REIT. Tax free. The dividends earned from REIT are tax free. Whatever dividend you are going to get on a monthly basis, that dividend or monthly basis or whatever is the terms and conditions, it is going to be tax free. It is not chargeable to income tax. Next, fast capital appreciation. Capital appreciation is going to be quicker. Easy to buy. You do not have to go and look for the property, see the situation, look at the documents, n number of things. The REIT trust is going to do all that work. You do not have to do that. You just have to make a right decision of buying the units of REIT. You just have, everything is available online. You don't even have to go anywhere outside of your house to purchase those particular property. You are purchasing the units of REIT. Minimum investment requirement is 10,000 to 15,000 as decided by SEBI. This is subject to regulation of the Securities and Exchange Board of India. So this limit might change as and when notifications come. Now, income, what are the returns that we are going to earn? Income of REIT, what is the income of the trust, and what is the income for the investors who are going to put their money in the trust. Both is important. For the trust, you are going to get the capital appreciation. The value of the property is going to go up. Today you bought the property at 10 crore rupees. After 5 years, that same 10 crore worth property could be 50 lakhs, right? I mean, if you have bought it at 10 crores, it will become 50 crores. That is, but the value of the property is going to go up over a significant period of time. And rental income. Because you have put in money in the income generating property, you have bought a commercial building, that commercial building can be further rented out. So constantly every month, the trust is going to get rental income on the property that it has purchased. So these are the two types of income for the trust itself. Now, whatever income is there for the trust, that income it has to share with the investors, and it can share in two forms. One is dividend. Whatever rental income they are going to get, they have to pass that over to the investors in the form of dividend, and it is mandatory for REITs to give out dividends. And price appreciation is that the unit of one REIT is going to go up. Like the share price goes up, the unit value of REIT is also going to go up if the REIT is going to perform well. So these are the two kinds of returns that the investors can get out of an investment made in the REITs. Next. Examples I've just taken: Brookfield India Real Estate Trust, Embassy Office Parks, Mindspace Business Park REIT. These are a few good performing REITs in the market. Next, moving to the next instrument, that is InvITs, that is Infrastructure Investment Trust. What we have studied just now, REITs, We have created a trust for the purpose of making an investment exclusively in the real estate sector. Similarly, invites are the trust which have been created for investment in the infrastructure sector. Everything is same. Operation is same. The way it operates, everything is same. It is just that the sector is changing. There we were making an investment in the real estate. Here we are making an investment in the infrastructure sector. So an invite is established as a trust and it is registered with SEBI similarly. Okay. Purpose, it is to provide a suitable platform for financing and refinancing the infrastructure projects and allow the investors to participate in the growth of the infrastructure. So they want money for infrastructural development. For that they can raise capital from investors like us, and once infrastructure is ready, obviously there is growth, there is income. That income can be shared by the investors who have contributed for that particular project. So infrastructure investment trust operates similar to that of REITs, where the trust is created for collecting the investment for the purpose of making in the infrastructure sector exclusively, and therefore sharing the profits and benefits of the infrastructure that has been developed. Objective of invites, primary objective is to promote the infrastructure sector of India by encouraging more and more individuals to make an investment in the infrastructure sector. So again, this is also a collective investment scheme where a lot of investors come together, create a pool of money, and that money is invested in the infrastructure sector. Next. It is similar to that of REIT. How REIT functions, like I told you, investors are there, they give the money to the trust, trust buys the real estate property. Here the money is put in the infrastructure project, and whatever income is generated out of that project is going to be shared with the investors. A tool is designed to pool money from several investors to be invested in income generating assets, and the cash flow thus generated is distributed among the investors as a dividend income. Exactly how REIT operates, even invites also operate in the similar way. Few important elements are the trustee, because you are creating it in the form of a business organization being trust. In the trust, we know one important element is the trustee, to ensure that the trust property is used properly and there is no manipulation, fraud or wrongful practices within the trust. To ensure that the money of the investors is safe, we are going to have a trustee. Sponsorer is the person who is conceiving this idea of setting this particular trust. And investment manager is the manager who is going to be required to make an investment decision of where we should put this money, in which project we should put this money, which avenue we should put this money, how we can get more and more income by putting this money in the infrastructure sector. And you have a project manager, because investment manager is the overall management for the entire trust. Under one trust, you might have multiple different projects that are going on. For every single project, you are going to have a different project manager. So who is a trustee? Trustee is going to be required to be registered as a debenture trustee with Securities and Exchange Board of India. He is going to be the trustee of the trust, that is the invite, and at least 80% of infrastructure assets that generate steady income. So it is their purpose, it is their role to see that the money that has been collected by invite, at least 80% of that money goes into the infra assets itself. Sponsorer is the person who is going to create this trust or get this idea of creating this business. So he himself should have a net worth of 100 crore rupees, should hold at least 15% of the total invites with a minimum lock-in period of 3 years, or as may be notified by the requirement. And when it comes to PPP project, that is public-private partnership, the sponsors serve as the special purpose vehicle. They are the people who conceive the idea of starting this invites. Investment manager is a body corporate or LLP. Investment manager supervises the overall operations of the entire invite. So he is the main person who is going to manage the investments. And project manager is at the project level. One trust can have multiple projects going on simultaneously. One trust could have made investment in multiple different projects. For every one single project, you are required to have a investment, the project manager. Next. I've just noted down some examples. India Infrastructure Trust, Bharat Highway Invites, Digital Fiber Infrastructure Trust, Highway Infrastructure Trust, Intelligent Supply Chain Infrastructure Trust. These are few trusts which are there in the infrastructure sector. Moving to the next category of instrument, it is the securitized debt instrument. Before going to understanding what is a securitized debt instrument, we should understand how this instrument is created. This instrument is created through a process called as securitization. The securitized debt instruments are created by a process that is called as securitization. What is the securitization process? Now what happens? A lot of people take a lot of loan from banks. That money becomes blocked for the bank. No, it is not available with the bank for utility because they have handed over to the person who requires it. I want to purchase a house. I have taken a loan of 5 crore rupees and the duration of repayment is 20 years. Generally home loan is 10 to 20 years, always long duration. For 20 years, the bank is not going to get back its money. They have to wait. Obviously, they're going to get the EMI on a timely basis. But even that amount, that duration is split for 20 years. In that case, for so many years, the money of the bank is locked. Plus, there are so many people, so many borrowers, so many people who take loan who don't even pay back the loan. There is a risk associated whether a particular person is going to pay back or not pay back. There is a risk element that is associated. There are so many NPAs, non-performing assets in the banks that they are gone. The bank is not able to recover the money at all from the people who have borrowed. Even if collateral is there, it takes time for the collateral to be sold and recovering that amount. Sometimes even the collateral is not sufficient to recover the amount that the borrowers have taken. In all these cases, the banks are at a problem. All their money is blocked. All the money is locked with the people who have taken loans. Yes, definitely they are going to earn higher rate of interest by giving out loans. But still their money is blocked with the people for a longer duration of time, because of which there is liquidity problem for the banks. Because of which there is a problem of non-performing assets also for the banks. To solve this problem, they came up with this process called as securitization. What happens here? The bank has a lot of receivable amount. They have given loan to n number of people. All that they have to receive over a significant longer duration of time. That takes time. So what banks does? Banks sells its loans. Whatever receivable amount is there, it sells that to a securitization company. That today you give me entire amount that I have to receive, and when that person is paying, you take the payment. I am going to exit. What is going to happen? Banks are required to receive a lot of money from various people. The bank tells the securitization company that all this you take from me. You take it from me. I am giving you everything. Today you make me the payment. You give me the entire value that I have to receive from many people. And when actually these people are going to give the payment on the due date or at the time when their maturity comes to make the repayment, all the money that comes, you take it. So the bank is selling its receivables to one more company. The bank is selling the loan that it has given to others to one more company. What is happening? Here we have one borrower, one person who has taken a loan from the bank, and constantly he is paying the EMIs. He is paying the EMI. Like this, not one but crores of people are there who have taken the borrowings from the banks. Now bank is going to have locked funds. All his money is locked. There is no liquidity. It does not have money for its operations or to put more money into the circulation. What it does, it contacts a special purpose vehicle or the securitization company. It tells that you please give me the cash. All the amount that I have to receive from the borrowers, you pay it to me. I will sell you all the receivables and loans. Whatever money I have to get on some other day, that cash you give me today only. I am going to sell my loans to you. Means whatever receivables I have, I am going to give it to you. You take it now and give me the cash. And it will sell all the receivables to the special purpose vehicle. So here what has happened? Conversion of debt into securities has taken place. It was a debt for the bank. The bank has given all that to the special purpose vehicle, and in lieu of that, he's made the payment of cash. Now, whenever later this particular borrower is going to pay this money, it will not pay to the bank because the bank has already given it to special purpose vehicle. After the process of securitization, all the installments that the borrower has to pay, instead of paying it to the bank, we are directly going to pay it to this securitization company or a special purpose vehicle. Okay. Now, for the special purpose vehicle to be able to pay so much cash to the bank and purchase its receivables, from where are they going to get their money? We understand that the bank has locked money because it has given so many loans to so many people. It wants to get cash of all the loans that it has yet to receive from people. That is huge crores of rupees. And it is telling one company, you purchase that from me. They are ready to purchase also. They are giving cash also. But from where will they get the cash? They will get the cash from the ultimate investors. Crores of investors, little how much ever amount they have, they are going to give the money. That money collective pool is going to be created, and from that collective pool of money, this special purpose vehicle is going to make the payment to the bank and receive that particular amount. Right? So the special purpose vehicle makes the payment to the bank. The payment that it makes, it is going to receive that payment from the investors. If investors are giving money to the special purpose vehicle, they will require some instrument in return. That yes, please give an acknowledgement that we have made a payment to you. We are going to issue them securities backed by assets, that is nothing but securitized debt instruments. Investors are going to make an investment in special purpose vehicle by giving them money so that they can make the payment to the banks. The instrument that the securitization company gives to the investor as a proof of his investment in the special purpose vehicle is called as the securitized debt instrument, where the conversion of debt into securities has taken place. It was a debt that has now been converted into securities. So they sell the securities backed by assets, and investors earn periodic returns. How will they get periodic returns? When these borrowers on a periodic basis are making the payment of EMIs to the special purpose vehicle, same is going to be shared by the special purpose vehicle with the investors who have given them the money to buy those securities. So they pay the cash for the securities to be given to the bank. Special purpose vehicle give them securitized debt instrument, and returns is whatever the borrower is giving the securitization company. Monthly basis, that return is further forward to the investors. So the installment received by the special purpose vehicle will be given to the investors as returns, and this conversion of debt to the securities is called as the process of securitization, and the company that is going to be involved, the special purpose vehicle, is called as a securitization company, and that is the company which is going to help conversion of debt into equity, where we are purchasing the debt of the bank by collecting the money from the investors. Investors give money to the company, company gives that money to the bank and solves the problem of the bank. Bank is outside the picture. Borrower is there, he is going to give his monthly installments to the special purpose vehicle. That installments are going to be shared with the investors as returns. This is the process of securitization. This is the place where the securitized debt instruments come into being. So what is the securitized debt instrument? It is a debt instrument considered as a financial security. It is created by securitizing individual loans. Like I told you, lot of borrowers will be there. Loans of the bank has issued loans, that is being purchased. So individual loans are going to be securitized. We are going to convert these loans into securities. Example, mortgage backed securities, because generally all these loans that are going to be given by banks are going to be based on collateral security. The bank very rarely issue any loan without the requirement of a collateral. So generally they are going to be secured loans. So it is going to be backed by some kind of security. Regulation, the SEBI public offer and listing of securitized debt instrument regulation of 2008 is going to become applicable in case you want to list the securitized debt instrument on the stock exchange. Benefits of securitized debt instrument: first and foremost, ensures liquidity. It is listed on the stock exchange, so you can, whenever you want, you can sell, whenever you want, you can buy these instruments. Lowers the interest rate, because if the bank's problem is solved, it is getting the money quicker from the securitization companies or special purpose vehicle. It can give these loans to the ultimate investors at a lower price. Lower interest rate for loans can be charged by the banks. Next, it frees up the capital from the bank, because banks lock-in period is 10 years, 20 years once they give these high-end loans for the investors. Now that can be freely quicked up. Quickly it can be freed up by special purpose vehicle. And lastly, it encourages the lending to reasons other than making profit. So here the purpose of the securitization company is not to make profits. It is to solve a problem that is in existence. They are going to charge a minimal fees for the entire process. But the main intention is not profit making. The main intention here is to solve the problem that the banks are facing. To bring in more liquidity into the market, to put the money into circulation is what is the intention, and profit making is not the intention. So people can make an investment for other than making profits. Now, Moving to the last category of instrument, that is the municipal bonds. Municipal, what is municipal? Municipal authority, local government, local authorities at the city level, right? Municipal corporations we have, municipalities we have, that is the word municipal. And bonds, you already know, it is a debt instrument. So what are municipal bonds? Whenever the municipalities, the local government needs money for running its activities and it wants to raise capital for its activities, for its projects, it can do so by issuing the municipal bonds. So municipal bonds are issued by the municipal authorities for the purpose of raising capital to implement some kind of project, right? So let's see. The concept of municipal bonds, it is issued by urban local government authorities and agencies. SEBI has issued and passed guidelines for issuing municipal bonds in the year 2015, and the purpose of raising or issuing these bonds is to raise funds for projects like infrastructure, road, airports, railway stations, schools, etc. So what had happened? Long back also we had concept of municipal bonds where local authorities were raising money by issuing these municipal bonds. But due to lack of regulation, lot of malpractices, wrongful fraudulent activities, lot of scams in the dealing with the government transactions, people had lost their trust in making an investment in the municipal bonds. Even if the municipal bonds were making issue of the bonds, people were not ready to buy these bonds merely because they were not having trust in these government agencies, in these government authorities which are raising the capital. There was a boom in the market, but when they saw a lot of fraudulent practices, people lost their trust in this particular instrument and they stopped giving response to this category of instrument, and slowly nobody tried to raise funds because they were not able to raise capital. That is when Securities and Exchange Board of India realized that when companies can raise capital, why can't we have any kind of rules and regulations for the government also, for these local agencies also to raise capital? Merely because it was not regulated, people did not have trust. If we put these municipal bonds also under the ambit of the Securities and Exchange Board of India, people will automatically have trust. People are investing in the secondary market, in the IPOs, etc. because you have a regulator. They know that SEBI is there to protect the interest of investors. Similarly, what if the investors who are making an investment in the municipal bonds, if they are also regulated by SEBI, will they not have trust? If these municipal authorities are under the ambit of the Securities Exchange Board of India, which is the watchdog of the market, it will help even the local governments to raise capital. With that intention, in the year 2015, the Securities Exchange Board of India has brought municipal bonds under its regulatory ambit, and it has issued certain guidelines for the municipal authorities for them to raise money or raise capital by issuing municipal bonds. And after this, okay, it has gone certain significant improvement, and people are inclined, or they wish, or they make contributions to the municipal bonds. Now, there are certain criteria for the purpose of making an municipal bond issue, that is nothing but eligibility. There are certain conditions that have to be satisfied by the municipal authorities before making a issue of a municipal bond. First and foremost is the municipality, the local authority, the local government itself should not have negative net worth in the 3 previous years. What is net worth? Net worth is what is the value of your holdings? What is your net worth? It is net assets minus net liabilities. So that means they say that you should not have a negative net worth. That means in all of the 3 previous years, your net asset should be more than your net liabilities. Your assets should be more than your liabilities. You should have some property for yourself. After clearing out all the liabilities also, there should be some asset in the name of the municipality. So the municipality should not have a negative net worth in the previous 3 years. Next. Second, the municipality should not have defaulted in the repayment of any debt securities, principal, interest thereon. So if the municipality itself has some kind of loans and borrowings, it should not have defaulted in the repayment of the principal amount, in the repayment of interest, or any other borrowings. They should have made timely payment of all the loans that they have taken, of all the borrowings that they have taken, only to give confidence to the bondholders that okay, they have paid the loans on timely basis, so even at the time of maturity of these municipal bonds, they will be in a capacity to pay back. right? So they should not have defaulted in the repayment of any loan, principal amount or interest amount. And lastly, in the municipality, whoever are going to lead the municipalities, the promoters, the directors, none of them should be in the list of RBI as willful defaulters. So RBI issues a list of willful defaulters, right? The name of these people, the promoters or directors, should not be there in that particular list. So what are the three conditions? First one is that municipality should not have a negative net worth. That means at all points in time their net asset should be more than the net liabilities for the 3 previous years. The municipality should not have defaulted in the repayment of the principal amount, interest amount or any kind of borrowings that they have taken. And lastly, the municipality itself, the promoters or the directors of that municipality should not be included in the RBI's list of willful defaulters. If this is satisfied, then they can go ahead and make an issue of municipal bonds and raise money for projects for the development of the city where that particular locality is covered. So this brings us to the end of the entire chapter, that is basics of capital market. I hope you all had a good session. Please study well and all the best for your exams.